going on, everybody? Happy Hump Day, happy FOMC Day, happy Jerome Powell Day, happy We Got Dressed Up Day. Welcome to Sin City Crypto Live. My name is David. I'll be one of your 4 co-hosts today. And today, like every day, we're coming at you live from our studio here in the heart of all hearts, Las Vegas, Nevada, with our daily live show. Today, of course, we're talking FOMC. We're going to talk about the impact of rate hikes. We're going to give you a background on the FOMC. What's happening next year? What can we expect? We have video clips from Jerome Powell. We have technical analysis. Gareth Soloway will be joining us. Magic Internet Money will be joining us. We have an absolutely packed show. Buckle in, hit the like button, and let me introduce you to your second co-host, Big Rob. What's up?
Hola! It's your boy, Big Rob, back in the house. Welcome to Sin City Crypto. If it's your first time checking us out, we're an entertainment-focused cryptocurrency channel where we take the old, the boring, the stale information and repackage it up in a suit and tie, fun kind of way. No, not wearing a hat and my hair's out. Wait.
What?
Yeah, bullhorn. Yeah, I mean, if you guys thought I was bald or perhaps had a receding hairline, it's not true.
It's receding on the sides.
You leave my hairline out of this.
Okay, fair enough.
All right. So, guys, if you're new here, if you're checking us out, make sure you say hello so that we can drop an hola right back at you. Super excited about today. Not only do we have the FOMC popping off, but Bitcoin at 18,000. You know what that means, baby, right? You got to pull out the bullhorns, baby.
What an idiot. Oh, man.
Man.
Speaking of Bitcoin, let's just jump right. We have, guys, I'm telling you, you're going to want to stay tuned in. We have so much content to bring to you guys. And we're going to start here. We're going to start with the cryptocurrency markets because we are a cryptocurrency show.
What?
We have the market cap coming in a smidge under $900 billion with 24-hour volume being at $36 billion. Rob, we expect this volume to go up, correct?
Oh, volume is going to be off the charts today. I mean, we have one of the biggest weeks in crypto history, right? You had the collapse of the third largest exchange on the planet, which happened a month ago. But now the CEO, Sam Bankman-Fried, is finally being held accountable. He is sitting in jail. That happened yesterday. And then on top of that, you got Bitcoin breaking out of the 17K range. We have been over a month since we've seen $18,000 Bitcoin. So, there is rumors out there circulating that the bottom is in. And also...
The rumors you created.
Yeah, it is my rumor. That is correct. So then on top of that, we had a super favorable, I don't want to say super favorable, but
was pretty favorable.
Pretty favorable CPI number drop yesterday, coming in under expectations. Markets were rallying yesterday due to the great news. And of course, we have the FOMC meeting, which is likely to end here in the next hour and some change, which we will have the new announcement of the new federal funds rate interest, which, we're going to discuss ad nauseum. Will it be 0.5? Will it be 0.75? Or will it be 0.25 with a nice pivot and moonshot straight up to 20K, right? I mean,
let's get the chat. Put a 1 if you think it's going to be 50 basis points. Put a 2 if you think it's going to be 75. And put a 3 if you think it's going to be 25.
Well, hold on. 1 is what?
1 is 50.
50? Okay.
2 is 75.
2 is 75.
3 is 25.
3 is 25.
All right? 50, 75, 25. What do you guys think? I think it's going to be 50, but I think what's more important is we're going to discuss here what we expect moving forward. We have a breakdown of the 2023 FOMC voters. We did a full biography on them. What can we expect? What kind of monetary policy moving forward? But in the meantime, let's get back to crypto and Bitcoin here. So Bitcoin dominance still under 40% and ETH dominance at 18.6. Like Robin did mention, Bitcoin, $18,106. If you are a TA fan, you're going to want to stick around. Gareth Soloway will be joining us in about an hour, followed by Magic Internet Money. And then Ethereum, 1336. You have Tether's market cap dropped a little bit. It was closer to $68 billion. We know what's going on with Tether. Apparently, they were loaning money to Alameda and FTX. We'll see how that all plays out. And then USDC, and then BUSD. So we have 3 stable coins in the top 7. BNB, XRP, rounding out the top 10, you have Doge, Cardano, and Polygon Matic. What are some of the biggest gainers of today? You have Toncoin, USDN, which is supposed to be a stable coin. Of course, that's depegged. XDC, and then Solana is up 7% over the last 24 hours. Biggest losers. Stacks, GMX, Monero, Bitcoin, Satoshi Vision, which I don't know who the hell is still investing in that. And then Osmosis down 1.2%. I want to move to a chart I created. So this is, you have two lines here, okay? In orange, you have the effective federal funds rate. And I've earmarked all the rate hikes and when it happened, and I've overlaid on this one, this is going to be the Bitcoin chart. So if we take a trip down memory lane and we see what kind of movement we see in the crypto and the stock market when these rate hikes are announced. So back here on, back in March, this was, I think the exact date was March 16th. We saw a quarter basis point rate hike, which we saw Bitcoin rally from $39,200 to $42,000. We had our 50 basis point rate hike on May 4th, which we saw a big drop in Bitcoin from about $39,200. We gapped all the way down to about $33,800. Then started the 0.75 basis point rate hikes. The first one coming on June 15th. It was a Wednesday. And Bitcoin's price on that day was $22,655. A day later, it closed right at the cusp of $20,200. Again, 0.75, same thing. This one, we didn't go down as much, but you can see the trend here. Every time it comes out, with the exception of one, which was a quarter base point rate hike, everything, Bitcoin's moved down. Now, what will we see if we see 50 basis points? My guess is 50's kind of priced in. Maybe a little less on Bitcoin versus the traditional market, but
definitely, I think the least volatility that we're going to see today is with the 50 basis point, because that is the expectation. And if we go in above or below, that's when we'll see an absolute shakeup in volume, not only in the crypto side, but also in traditional finance on the S&P 500, Dow Jones, and the NASDAQ. So,
speaking of NASDAQ, someone in the chat mentioned you should do one overlay with Dow. Well, I got one overlaid with NASDAQ. So same thing, same interest rates plotted. And we see similarities. We see on March 16th, 25 basis point rate hike. NASDAQ rallied from 13,100 all the way up to about 13,900. 50 basis point rate hike saw us go from 12,900 all the way down to 12,300. That doesn't sound like a lot, but in the traditional market, that is a big move. The very first 75 basis point rate hike, which was on June 15th, we saw the NASDAQ gap down from 11,000 all the way down to 10,600. So not as big as the 50 basis point rate hike, but still a pretty big move. And then, of course, everything else, with the exception of July's rate hike of 75 basis points, saw the NASDAQ actually rally. Saw the NASDAQ rally from about 12,000 even. You can count all the way up to 12,400. The top of that mini cycle was 13,100. And then we came back down and we kind of been trading sideways.
So a couple things, and then we can kind of break down a little bit of analysis on this chart, just to kind of. So the expectations have moved on the forecasted interest rate hike. So taking a look. The CME has moved from 75, which was earlier this week on Monday, all the way up to 79.4, so almost at 80%. This is probably increasing because of the CPI number that came out yesterday, and the 75 basis point rate hike is coming in at 20%, down from 25%. So it seems as though the traditional finance is betting on a 0.5% interest rate hike. And then also, just to give you a little perspective on the new calendar coming out for the FOMC, our next meeting will be on February 1st, or that's going to be the new announcement. And then here's the rest of the calendar, which will be following. So we have no other rate hike until February, and then followed by March. So yeah.
Okay. we're going to cover that more in detail as well here in the next few minutes. Now we know the traditional markets react before the cryptocurrency markets. So if we see a big rally in NASDAQ, in the Dow Jones, we can expect to see a similar rally in the cryptocurrency markets. The good news is we're going to have two of the top TA experts with us live when this news hits. All right, let's move on. So yesterday, CPI numbers came out. Let's move on to what we're looking like as far as CPI. And so if we pull this up here, we have the 2022 CPI print, and to the right is the 2022 core inflation. And you can see here, since we topped out in June at 9.1% on the headline CPI on the left, we've been trending down. We went from 9.1 to 8.5, followed by 8.3, 8.2. We saw a 0.5% move to the downside from September to October, year over year. And now we came in our biggest dip since June, which was 60 basis points down to 7.1. But on the right is what's more important to the Fed, which is core inflation. It started to come back down after September. We went from 6.6 down to 6.3, which at the time in October, they were expecting sub 6% core inflation. So the 6.3 was a surprise to the upside for them. And now this month, year over year, November, coming in at 6%. Jerome Powell did speak at the Brookings Institute, where he talked about slowing inflation. And we have the video clip for you guys.
Well, real quick, before we jump into the video, I just want to give a little love to the chat here. First of all, we had a super chat by Big Chili Willie. Dropping a $4.99 super chat. He said, hit the like for a 0.5 rate hike. And then we do have a few new people in the chat as well. And that, we're going to start with Sam S. Muhammad, Jessica, Cisco Javi. We got Sci-Fi Flyer, Lift Up a Banner, Toby, J-Bro. Hola! Welcome to Sin City Crypto. Guys, do us a favor. We're trying to break some records today. We're trying to get a lot of people in the chat. We can only do that if we got a lot of likes and a lot of conversation going on in the chat. So make sure you hit the like, support us. If you like the way David looks with a tie on, because he's normally pretty scrubby, put a 1 in the chat as well.
There's a guy who always wears a hat.
That's right. And then we will open up the club if we reach 500 people in the chat today. I think we can get to 500. You think we can get to 500?
I think we're definitely.
If you're not familiar, stay tuned. Thank you.
That's right. All right. So back to the content. We have Mr. Jerome Powell, the chair of the Federal Reserve of the United States of America, spoke at the Brookings Institute on November 30th regarding slowing inflation. Well, here's what he had to say.
Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories: core goods inflation, housing services inflation, and inflation in core services other than housing.
So let's break down. So he talked about core minus core goods, housing, and then core goods minus housing. And so this is what we have from yesterday's CPI print. So on the left we have the headline CPI, which was 7.1. On the right we have the core. Food coming in at 10.6%, energy 13.1%, with gasoline at 10.1%. If you remember, this was as high as 70 to 80% a few short months ago. So definitely positive trends that way. On the far right is the November core inflation. So everything minus food and energy. And the reason I do that is because those are the 2 most volatile. The only thing we're missing is the housing, which is recently has been very volatile as well. But that came in again at 6%. You have, I think the anomaly here is used car vehicles. And part of that probably has to do with the catch up of chip production. We were having some issues with the supply chain as far as manufacturing chips due to lockdowns and everything. And so people were getting ridiculous amounts of money. I mean, I have a 2014 Mazda CX-9 that paid off, and I was getting offers for $15,000, $16,000. That has 100,000 miles on it. So that's coming back into kilter. New vehicles still up 7.2%. And then shelter 7.1 and rent or primary residence 7.9%. It was getting to a point where people had to pick between, do I go buy snacks for my kids or do I pay my rent? Do I pay my power bill? Anything
snacks aren't healthy, so
snacks are very healthy. What are your thoughts on just this breakdown of either the headline or the chord? Did anything surprise you right off the bat?
As you mentioned, the used cars, I was expecting it to come in down. I didn't think it was going to come in negative. So negative over 3%. That's pretty substantial. And then, I think outside of that, everything was kind of expected. The prices are starting to come down a little bit. You see the average cost of a 30-year mortgage, the house for a house is coming down. A lot of steam came out of that market. Rent is finally starting to stabilize as well, and so not terribly surprised. Put it that way. Do you
expect
think
this trend to continue?
Yeah, which I was going to say, do you think we'll print a 6?
Sub 7?
Yeah, sub 7. Dude, we're only 0.2, and we dropped, what was it, 0.3 last from last month to this one, right?
No, 0.6.
0.6?
We went from 7.7 to 7.1.
7.7 to 7.1. So,
which is a pretty big jump.
Yeah, and if you think about what it looked like a full year ago, we were growing exponentially when it came to inflation. And so if we're dropping at the same time, you have two different factors. You have converging factors. You have the year over year, which 1 year ago, we were starting to go parabolic, where we went from 3% up to 9% pretty quickly. We're starting to catch up to that rate. And so if you were to extrapolate that out 1 year, we're coming down at the same time a year ago is going up. You're going to see more dramatic increases or decreases in this case in the numbers. So I think 6.5, would be realistic. 6.3, I think we might see a dramatic drop in the number.
We'll see. I think that comes down to, with the December CPI print, that's going to be, of course, announced in January.
Let me ask the chat. Do you guys think, and by the way, our poll earlier, a lot of people, we had majority of people put 1 in the chat. There were a few 2s and a couple 3s. But I think our community here does believe in the 0.5 rate hike as well, which we're all kind of in agreement. That's probably where it's going to go, but you never know. So let me know, chat as well. What do you guys think the rate is going to be next month? Do you think that we'll be at sub 6? If you think that we're going to drop under 6%, we'll be at a 5 point something. Put a 1 in the chat.
So you're saying there's going to be over a 1% decline?
I think it might. I truly think it might, because this was when we were starting to go parabolic up, and I think we're going parabolic down on the back end. So, 1 in the chat if you think it's between 5 and 6. Put a 2 in the chat if you think it's between 6 and 7. So,
okay. Now, Rob, what is one key factor that the Fed keeps referring to as far as them having runway to continue to hike?
The labor market.
The labor market. Mm-hmm. Unemployment.
Yes.
Well, we have some unemployment numbers for you guys. So on the left here, you'll see the unemployment rate shown in percentage, and then job openings. And so you can see here, these are both 1 year. You have the unemployment rate been essentially at 3.7 for 3 out of the last 4 months, which is considered low. We saw over 10% during the COVID lockdowns. We also saw over 10% during the 2008 financial crisis. But interesting, job openings, they peaked in July, and these are in millions or in thousands. So 12 million job openings came crashing down to just over 10 million. And now we've seen a trend to the upside in job openings. What does this tell you? What kind of picture does this paint for you, right? You have the unemployment rate staying steady, but job openings going up. If job openings are going up, why isn't the unemployment rate going down? People aren't taking jobs. What's your what's your stance on this, Robin?
Honestly, I don't know, man. I think we're in. I really don't. I'm like trying to think about it. I'm no economist when it comes to the labor market. So all I can do is speculate. But you had the giant resignation of all of the baby boomers, the largest population base in the U.S. all coming of age of retirement. A lot of them retired during the 2020 pandemic when they were, either laid off or told to close up businesses. And so a lot of them didn't come back. You also have other factors as well, where you had the halting of immigration during all of the 2020 fiasco as well. And so, are immigrants coming in and providing jobs? Are they streamlining back in? I don't know.
You mean, are they taking jobs?
Yeah.
Is that what you're saying?
Yeah.
I mean, my short answer is no, right?
Yeah.
We're seeing job openings go up and the employment rate stay the same. But you mentioned the great resignation, people retiring. Well, Jerome Powell did speak about excess retirements again at the Brookings Institute on November 30th, and we have the video to show you guys.
Recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force. What explains these excess retirements? So health issues have surely played a role, as COVID has posed a particularly large threat to the lives and health of the elderly. In addition, many older workers lost their jobs in the early stages of the pandemic when layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers, given pandemic-related disruptions to the work environment and health concerns. Also, gains in the stock market and rising house prices in the first 2 years of the pandemic contributed to an increase in wealth that likely facilitated early retirement for some people. The data so far do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees.
Okay. Here's something. Job vacancies. This is sourced from the U.S. Bureau of Labor Statistics. You can see a trend just over the last 3 months, a trend of job vacancies moving to the upside. So more jobs are available. Unemployment is the same. Is this a cause for concern for the Fed? Because you got to extrapolate, right? You got to think, okay, if there's all these job openings and the unemployment rate is low, that means people aren't applying for these jobs. Which means, what do the companies have to do to get people to come work for them? Anyone? Robin?
Yeah.
Pay more money.
More money.
Wage increase.
But that goes to...
And guess what wage increases affects, guys?
Yeah.
Inflación.
Oh.
AKA inflation.
Españoles?
Mucho español.
Oh.
Is this a negative... in regards to seeing a Fed pivot, you think there's any possibility the Fed pivots with unemployment this low and job vacancies this high?
No, because at the end of the day, their concern is bringing down inflation to their target range between 2% and 3%. And until they get at least close to it, because I mean, even though it is dropping at a faster rate than it was before, we're still at over 7% inflation, which if you were to ask somebody in any kind of position of power, especially at the Fed, hey, what do you think would happen to our economy if we were at 7% inflation? They would friggin' pull their hair out. And they would be like, that could never happen. And if it did, we would take extremely aggressive stance. And so there's no pivot on the table until at least 4%, right? Until the federal funds rate is comparable, the interest rate is comparable to the inflation rate. So when both of them are at 4%, or both of them, or the federal funds interest rate is at 5% and the inflation is at 4%, either way, those got to come into a closer balance. There's been a lot of people talking like we won't ever get a hold of inflation until we flip and the interest rate is above the inflation rate. And so until we get close to that, there's no pivoting. Now, some people are defining pivoting as a pause or a stop. I think that's likely. I think that if we do see, for example, 5% inflation number coming out of CPI at 5%, then I think it's possible that they go to a 0.25 or maybe just not raise it at all and see where it goes from there. But I don't think they're going to reverse course. So,
Jerome Powell, again, at the Brookings Institute on November 30th, he spoke on wage increases and the kind of effect it has on in relation to inflation. And so here's what Jerome Powell had to say.
The inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So,
okay, what are your thoughts?
I don't know, man. I don't know. What are your thoughts?
Well, like I mentioned before, we're in quite a bit of a pickle here. You're either going to have to up the age of retirement or somehow manipulate benefits to where people are kind of forced to re-enter the market, right? The labor market, or you're going to continue to see this, right? People understand, the workers understand that they have an upper hand with the employers. So they can go in there and they can interview and say, well, I want $30 an hour. And if you're the employer and you're like, damn, this is a really good candidate, everyone else that we have hired or not hired, but interviewed has been lame. This guy is solid. He'd be so good for the company, but we're only offering $15 an hour. Can we afford 30? And so now what do you do, right? As a business, I want to know your thoughts on that. I want to know, is there a way out of this? Job vacancies, can we bring the labor market back?
Here's the thing. I mean, we're starting to see the layoffs speed up. And Meta laid off 11,000 workers like last month, I think it was, or 2 months ago. And that's a huge amount of workers. And they said that was their first round. We've also seen layoffs from other tech giants as well. And, I think this is going to be something that progresses. And remember, everything that the Fed does, every time that they raise interest rates, you're not going to see the implications of it until months down the road. And, it's not like it's, hey, we adjust the dial. All of a sudden, yes, you see the interest rates on your home mortgage go up right away, or on your credit card bills go up right away. However, it doesn't play through the economy for 3 to 6 months out. And that also goes for the labor market. So it wasn't that long ago. We were still under 1%. When were we under 1% federal funds rate? It was only like 4 months ago, right?
No.
5 months ago? When was it?
It was in January, like beginning of the year, January, February. We didn't see our first rate hike until March.
That's what I'm saying. But the first one was 0.25.
Correct.
Then the next one was 0.5.
Correct.
So then the third one, that's when we went over 1%. And so where I'm getting at is that it's only been,
I see what you're saying.
It's only been like 6 months. I don't know. I know you have the chart there at somewhere where we discussed our previous rate hikes, but it's only been about 6 months where we've been over even 1%. And so it takes time for this to play through the system. And I'm kind of scared of what the labor market's going to look like 3 months from now.
Well, here's the
5
thing.
months from now.
Real wage growth is not keeping up with inflation. That's the problem. Is the wage increases are going up, but it's not keeping up with inflation, which is the point of a wage increase, right? Inflation goes up 2%. Your wages go up 2%, so you can maintain the same lifestyle that you're living and pay for the same things that you're paying for. But that hasn't been what's been happening. Not just in the last 6 months to a year, but over the last 2-3 decades. And so that's a big issue. All right.
I do want to take a moment to say hello to this.
Yeah, real quick. Before you do that,
What's up?
Flavio wants to know, why are we so formal? Did you guys become stock market guys?
I was actually going to address that too. I was going to address that, and like I dressed myself this morning. That's right. Okay. So if you're new here, say hello so we can drop an hola. That's without the H. Back at you. All right. So we got Crypto Fuse, JBFL. We got Reed, Mr. Kennedy, 123, Dean Jennings. We also got Mario, Tadios, and Amandeep S. Hola! Welcome
Did you say Amandeep?
That's literally.
Amandeep? It's Amandeep.
A man?
I'm so sorry, guys. We're a man short, Robin's a man deep. So I want to move on. So for those of you wondering, Gareth will be joining us in about 40 minutes. Okay, so 10:45 a.m. Pacific, 1:45 p.m. Eastern Standard Time. But we have a lot of ground to cover before he gets here and before we go over the charts. And the next part of this FOMC special today I want to talk about is rate hikes and the impact it has had on our economy, on our lives. And so before we get into any numbers, any charts, I want you guys to understand a little bit of background about the Fed, what its role was, what its role is, and kind of an example of how inflation works. This was put together by our man, Kyler. It is so good. I am so excited for you guys to watch it. Rocco, roll it. President Woodrow Wilson signed the Federal Reserve Act into law on December 13th, 1913, after the Panic of 1907 forced the government to look to wealthy investors like J.P. Morgan to bail out the public. Although the Fed currently serves as a conductor of monetary policy and maestro of our economy, price stability, max employment, and interest rate maneuvering weren't part of the original Federal Reserve's duties. They were created simply to make the American banking system more stable and improve the flow of money, which in turn will put the American public at ease in regards to their money being safely held at their local bank. Fast forward over 100 years, and we now have arguably the most powerful entity in the world with the power and capability to sway not just the American economy, but the global economy in its entirety. The Federal Reserve System consists of a chairman, vice chairman, 5 board members, and 12 district presidents spanning across the continental United States. This group of individuals are referred to as the Federal Open Market Committee, aka the FOMC. They meet 8 times a year to discuss and vote on monetary policy. The Fed has 5 main objectives: manage inflation, promote maximum employment, supervise the banking system, maintain the stability of the financial system, and provide banking services. Over the past 12 months, the Fed's main focus has been to get inflation under control by increasing the federal funds rate. The federal funds rate, also referred to as the FFR, is the baseline rate that banks use to borrow and lend money to one another. The FOMC has the power to vote to either increase or decrease the FFR, which in turn increases or decreases borrowing costs to consumers. Here's an example. The Fed increases the FFR by 50 basis points, or 0.5%, which makes it more expensive for banks to borrow money from one another to cover liabilities and meet reserve requirements. This in turn causes what's called a ripple effect, where banks pass that expense down to the consumer, aka you. They raise the interest rates on your credit cards, personal loans, car loans, and home loans. This tactic of raising the FFR is so the Fed can siphon money from the economy, which decreases spending as borrowing to purchase goods becomes more expensive, which has a direct impact on prices, aka inflation. The idea is to quell demand, suppress inflation, and stabilize prices. What kind of impact has a higher federal funds rate had on the economy thus far? Let's talk about it. Let's talk about it. Here's what we've seen so far with the interest rate hikes, okay? In March, 8 meetings per year outside of any special meeting that emergency meeting, which we have not had this year. Out of the 8 meetings, 6 times we have seen a rate increase from the Fed, which is historical. In March, we saw a 1/4 point rate hike. In May, 50, and then 4 consecutive 75 basis point rate hikes. That is kind of like going from a sauna, right? It's a little warm outside. You go to the gym, 25 basis points. You step into the sauna, it gets hotter. You're sweating. June comes around, you go straight from the sauna into an ice bath. That is literally what happened with the federal interest rate hike with the
Are you a sauna kind of guy? I'm just curious here. You like the dry heat?
I'm more of a steam room guy.
I do like the steam room.
Yeah. Now, what kind of impact does federal interest rate hikes have? So, rates that are likely to rise, again, credit cards, new mortgages and adjustable mortgages, new car loans and savings and certificates of deposits. What's not likely to change or rise due to the interest rate hikes is your existing fixed rate mortgage, existing car loans, and federal student loans. Those are locked in. So anything with the interest that is locked and fixed cannot change. If you have an adjustable rate loan, personal loan, adjustable rate mortgage, all the credit cards, their interest rates are all adjustable. So that goes up. And this is where that ripple effect comes in. What are your thoughts on everything? Do you think from the inception of the Federal Reserve and how they were only meant to stabilize and quell people's fears, right, with the bank runs, to what it is now, essentially dictating the global economy, you think they have too much power?
Well, I mean,
good question.
They do have a lot of power.
By the way,
now, whether or not they need it or not, that's a different story. Now, it's interesting that, so with all those cause and effects, basically, where you had the interest rates going up on your credit cards, on new mortgages, new car loans, and then also your savings accounts. Well, the savings account, first of all, that's a positive, right? Because if the banks can incentivize their customers to store money in a savings account, which then gets rehypothecated and used by the bank elsewhere, it's a cheaper borrowing rate for the bank to borrow from its users than it is from the bank itself. Because right now, the federal fund interest rate, where they borrow amongst each other, one bank borrows from another, it is at over 4.5% now, or 4.25%. And so, they're incentivized. So that is one positive to this, is that if you're used to getting your, what's the 0.01? What's the interest rate for a savings account nowadays?
0.000 XRP. Just kidding. It's less than 1/4%.
Yeah. And so we might see a scenario where if the federal funds interest rates keeps growing at the rate that it is, and we're at, say, over 5%, over 6%, which I know we've had discussions that's not possible to break the ecosystem that is the economy. The banks might try to incentivize the flow of money into their, from the users. And how do they do that? Hey, we'll give you 1.5% on your savings account. That could be something we see. It's something that has historically happened.
Really, Robin?
All right. So then now anyway,
what you have seen with the interest rate hikes is you've seen record-breaking profits and revenue for these banks. And when I said it on a show a couple weeks ago, hey, when interest rates go up, a good investment is bank stock, JP Morgan Chase. And everyone gave me crap, but I'm telling you, man. I mean, it's if you break it down, if you break everything down to its core base level, who benefits from high interest rates? If lending gets more expensive and borrowing gets more expensive, and you're a lender and you get to charge more interest, it's pretty common sense.
But also, I do want to say that those items are all directly affected, the next week, short-term impact right away is felt. And what isn't on those charts is the price of goods. the labor market, the economy in general. These are all also affected by the rate hikes. We know when the rate hikes are down, there's more investment in speculative assets. People have more borrowing power, and so you have new startups and businesses. Larger businesses expand; they hire. So, it's not just, hey, interest rates go up, so does your credit card bills and your your homes, but just overall, the entire economy is dramatically affected by these interest rate hikes as well. So,
So we're on this whole what impact have the rate hikes had? We've talked about spending. Well, here are some spending metrics here. So this is sourced from the U.S. Bureau of Labor Statistics on the far left, which is consumer spending. That's in terms of dollars in, I believe, millions. And then you have from the New York Fed on the right, consumer credit card debt. Okay, so this is pretty interesting. You constantly hear. Let me put something out there for you guys. When these bank CEOs, CEO of Bank of America, Jamie Dimon from Chase, when they speak about the economy, what do they always say? Consumer spending is still up. Ask yourself, why are they having to spend more money? Is it because the economy is so good? Is it because they're making so much money? No, it's because everything costs more money. You can see here on the left. It's been going up since freaking July of 2020. Consumer spending has been going up. Guess what else has been going up? Consumer credit card debt. Consumer credit card debt has been skyrocketing. And here's an even more, some more morbid facts, right? This is from the Federal Reserve Bank of New York. Commercial bank interest rate on credit cards, okay? Look at the very last diamond on the far right. We are at the highest since 1996. This is the interest rate you are getting charged on your credit cards. The highest, okay? Here's another stuttering fact. This is delinquencies on credit cards. That is moving to the upside, right? We had delinquencies, obviously, in the shaded gray areas have been recessions. You saw a big spike in 2008. You actually saw a move down in 2020 with the COVID crash.
Because everybody was throwing a bunch of cash straight out
off their cards.
Right out of the executive helicopter.
And, and now we see the delinquencies go back up. Robin, this is a scary trend for banks, for these credit card companies. Obviously, inflation is high. People are spending more money at the stores. Obviously, based on what I showed you, they're using their credit cards. And now on top of it, delinquencies and credit cards are going up. What kind of ripple effect do you see, A, that it's already had, and B, that it's going to have moving forward?
Well, there's always, this chart says it itself, there's always been a correlation between recessions. Basically, people are getting laid off. And what happens if you get laid off? You're going to max out your credit cards because at the end of the day, it's fight for survival. And so if you're one of the 11,000 people that got laid off from Facebook and you're having difficulty finding a job in the IT sector because nobody's hiring in that field, and you have $30,000 worth of available credit line, you're going to stay afloat, all right? You're not going to sell your car. You're going to need it for interviews. You're not going to move out because the cost of moving is pretty substantial. So you're going to keep paying your mortgage. And so it's a compounding effect because now not only is your minimum payment now is up by 30% from where it was, 20% from where it was. Instead of paying $50 minimum payment, you got to pay $80 minimum payment. And I've seen it firsthand with my credit card bills. And I don't know, man, this is all part of an integral grand economy that is all moving in a certain direction, and it is a slowing economy. Now, whether or not we've bottomed in the traditional markets, maybe we go further down. I do think that with the reversal of the 75 basis point hikes, basically come back to some kind of reasonable number, 0.5, 0.25. I think that is a good indication that we're turning the corner. However, I do think there's another couple months where we're going to see significant layoffs, especially after the holidays. as soon as Christmas is over, is a lot of retail is laying off or removing the holiday staff that they brought on. And, it probably won't be until February, March that we will see another uptick where we come out of this. And that is always been a good economic time for the U.S. because of tax returns. People are, they have an extra $2,000 to $10,000.
There's an extra 87,000 IRS agents. I don't know.
Yeah.
They're coming after us.
Yeah. So,
this is, here's what I can see happening, right? I can see people just saying, screw the credit cards. I don't care about my credit. I can't buy a house. It's too expensive. Can't buy a car. It's too expensive. Everything's expensive. So screw the credit card. I can see people doing that. And what kind of effect will that have on these banks? Are they going to need a bailout from the federal government, from the central bank? Think about in terms of that moving forward. And if this, I don't want to call it an apocalypse, but if this happens, well, not an apocalypse. It won't be that bad. But if this happens and these banks get a substantial increase in delinquencies from their consumers in regards to either personal loans, credit card loans, or car loans, and they need a bailout from the government or they need a bailout from the central bank, are they going to get it? Will the central bank cave in? And one of the voters on next year's FOMC board, that person would vote yes, we should. And we'll have that breakdown here coming up shortly. People are saying, Robin, you look like a banker. Is that the look you're going for?
Yeah, crypto's down. So, your boy
banking is up. We did talk about bank stocks.
That's right.
We're also going to talk about some other stocks and how money flows and where you can make money in a landscape where you see rising interest rates. But first, I want to talk about the M2 money supply. Robin, you'll be happy to see this. It has been going down since August.
Yay.
So I guess quantitative tightening and all that fun stuff is working out. But again, we saw this thing.
It's not the money printer now, it's the money eraser, right?
Yeah.
What was that Arnold Schwarzenegger movie that he was the eraser, you know what I'm talking about? Yeah. Oh. Rocco said eraser.
Okay.
What a great movie, man.
Yeah, it was a great movie.
Did you ever watch that movie?
No.
You didn't? Oh, look. This is when Arnold was nice and young. Look at that handsome man right there. He has two M60 machine guns that he can fire with. Usually it takes like a two-man team to even lug one of these around. He's double fisting these things. So
wow,
yeah,
that brought so much value to the stream, Robin. Thank you so much.
I'm the racer.
What would we do without you? I want to stick to what you have been erased. I want to stick to what you guys came here to see. By the way, if you're new here, please drop a hello.
Speaking of which, I want to say hello to some of the people in the chat. We got some new people here. If you're new, say hello. I want to know, first of all, why the hell we're at a sub 50% like ratio. That means for every two people that are in here, one of you has not liked this video. And I ask you why.
Excellent math.
We should have created a chart for my math skills. So anyways,
you probably wouldn't understand it.
Hit the like button. If you're driving in your car, pull over, turn on the hazard lights, and then hit the like button. If you're sitting at home, what the hell are you doing? Put the oatmeal down and hit the like button. All right, so a couple new people in the chat today. We got Crypto Fan Chris Ivalov. We got Joshua Scott. We got Bully Berry, Red Robles, Randomness, Armzilla, Dashing, BH. Hola! Welcome to Sin City Crypto.
Yes. All right. So we've covered we've covered interest rates. We've covered unemployment. We've covered money supply. Well, what about the Fed's balance sheet? You remember when they went into this hawkish Federal Reserve state, you can call it. Jerome Powell did say for 3 months, we're gonna let $45 billion worth of our securities and what we hold on our balance sheet, we're gonna let it go. We're not gonna renew. And then after that, for the next 3 months, it's gonna double to $90 billion. Well, where are we at today and what have we seen? Well, here you go. This is from the federalreserve.org website, the official Federal Reserve. And this is going all the way back to 2008. And so in December of 2008, we saw the Federal Reserve balance sheet get up to $2.2 trillion. And if you look over to the right, I have circled March of 2020, which of course was C-19, the lockdowns, where the Fed went on a buying spree, quantitative easing, which, by the way, did you know quantitative easing wasn't even a thing until 2008?
Yep.
Mr. Ben Bernanke.
Well, they had done it in the past intermittently, just like, for a certain case or a certain example or for a certain company. They had never had it as a broad policy where they were just taking baskets of companies, just like, hey, if you're in the housing market, we're just gonna helicopter you some money. Basically, we're gonna buy up your corporate bonds. So
Joshua Scott brought up a good point. Brought up mortgage-backed securities. That is the one thing the Fed has not committed to letting run off their balance sheet. There's about $2.7 trillion in mortgage-backed securities, which is, I believe, by far the most out of anything else, Treasury securities, whatever. If they dump those, you want to talk about a housing crash, and they know that. That is why they're not doing it. But you can see here, from March of 2020 till April of 2022, where we hit our peak at $8.9 trillion on the Fed balance sheet, we've seen an increase of 211% over a matter of 2 years. Of course, you can see to the far right, it is trending to the downside. Jerome Powell was asked at, again, the interview at the Brookings Institute, well, when are you going to stop with the balance sheet reduction? And here's what Mr. Powell had to say.
What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you should end the shrinking?
So I should refer you to a document that lays all this out in detail that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right. Yeah.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Pretty much wing it.
Relax.
So we're in an ample reserves regime, and what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we've said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. Having a lot of reserves in the system is really a good thing. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system and the financial system generally. So that's how we would do it.
What I don't quite understand is, aren't they trying to take money out of the economy? Right? And if he's talking about we have ample, more than enough reserves, liquidity, economy, it's good. Well, if it's there, that means the banks are going to keep lending. Not only are they going to keep lending, but they're going to keep lending to people with subpar credit. And those are the people that are going to go delinquent on their credit or loans.
The economy is almost in an addictive kind of dependent way when it comes to this economic situation, which is the balance sheet and the buying of corporate debt. And it like we mentioned before we played that video, it wasn't a thing before 2008. But now the economy has gotten so dependent on it. It's like a drug. And if you were to take it away, there's going to be issues that arise from it. And so I think we're in a spot where, hey, you can't just ditch it. You can't just stop giving money out, because now business models are relying on it. Banks are relying on it. Huge companies are reliant on handouts from the Fed. Same way that you have for all federal programs. Somebody gets economic assistance as a person, as a small person. A lot of these people, it stifles sometimes it'll stifle their motivation to go out and get a high paying job, because they're like, hey, if I keep my my salary below this threshold, I could keep receiving benefits from the government. It's no different when corporate. It's no different for corporations. And if you are teetering on profit and loss, if your margins are a lot slimmer, or if you took a loss this year, quote unquote, like Trump took a loss every year on his taxes, then you can get assistance from the government in the form of quantitative easing, in the form of money. And so I think they might shrink the balance sheet. They might slow down quantitative easing, but the business model that is quantitative easing ain't going nowhere. Here's I want to just take a really quick intermission because I feel like this is pretty important. Outside of the federal funds thing, I want to show a video here. Let me make sure I'm good here. And then let's see here. Rocco, I'm gonna play this.
Why do you believe it?
Okay, so this is Mr. Toomey. So the hearing is still going on. So this is Mr. Toomey. This is only about 30 seconds, so I feel like this is provides a lot of value. So
why do you believe FTX failed?
I have an opinion. I don't have the records. Here it is. These two behemoths that own the unregulated market together and grew these incredible businesses in terms of growth were at war with each other. And one put the other out of business intentionally. Now, maybe there's nothing wrong with that. Maybe there's nothing wrong with love and war. But finance is a massive, unregulated, global monopoly now. They put FTX out of business.
Why do you believe FTX failed?
Hold on.
yeah.
This dude is a clown, man.
So the fact that you spent $8 billion of customers' money, it is now Binance's fault. Binance went in, said, Sam, you grab customers' money and you go spend it. That's what he's trying to say, man. You know what? Our theme of our show did not have anything to do with FTX, but I had to show you that.
I know, right? It comes from a guy that is a shark.
We're definitely talking about this tomorrow.
Unbelievable.
What are your initial knee-jerk reaction on that?
I'll save it for tomorrow.
Mm.
Yeah. I don't want to get too worked up. I'm on a schedule here. Now I want to go back to FOMC. So we're on the topic of rate hikes and the impact it's had. It isn't all doom and gloom when interest rates go up. Of course, we talked about banks, but there's another entire sector of stocks that benefits when rates go up. And here it is. This is a chart this is from TD Ameritrade. S&P 500 Pure Value Stock Index versus the S&P 500 Pure Growth Stock Index. So you have growth stocks and value stocks. Value stocks are the slow movers, the ones that pay dividends on time, the ones that have a low market cap, the ones that are maybe in a little bit of economic trouble, the ones that have a lower P to E, right? Profit or price to earnings, right? Price per share to earnings of the company. Those are called value stocks. Then you have growth stocks. Think about like a high-speed train. Think about it like growth stocks are like the hare. Pure value stocks are like the turtle and the hare, right? One slow and steady, one is just bam. You can think of stuff like Tesla, something that's got a high P to E, something that's got a high market cap that's growing over 20% a year. Those are growth stocks. And you can see here, back in January of this year, when the monetary policy turned, in dark blue, you have the value level change, right? The value stocks. This has gone up. They've kind of diverged. Value stocks have gone up. Growth stocks have gone down. Same thing with ETFs. So this is in relation percentage off their high, okay? You have in dark purple, you have the growth ETFs. In orange, you have the value ETFs. And then you have the core S&P 500 ETF in general. You can see that the growth ETFs are over 30% off of their local highs. The overall core is down 23%, and the value stocks, the ETFs, are only down 16.21% off their local highs. And so if you're looking for more, and of course, right, none of these have been in the green, but you're talking about minimizing losses, getting into some value stocks versus growth stocks. Here are some examples. On the left here, you have some growth stocks, AMD, MPWR, FCX, PFE, which is Pfizer, and NUE, and then value stocks in the blue on the right. Some examples include AGX, SAFT, ASOA, blah, 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 blah. Are you I'm curious, Robin, do you have any investments outside of crypto?
No.
And outside of your home?
Nope.
No stock market?
Nope.
Nothing.
Nothing.
You think that's a good idea?
Yep.
Terrible idea. What do you guys think? Are you crypto only, or do you like to diversify and get into the stock market as well? Put a 1 if you're crypto only. Put a 2 if you're diversified, you're traditional and crypto. All right. Yes, I did do a ton of research on the show.
It
All
should
right.
be a number 3 too, so somebody doesn't have
Number
crypto.
3 is
no crypto.
Oh,
number 3 is I don't believe in investing.
Oh, what were the numbers again?
1, only crypto. 2, both.
Okay.
And 3, I don't invest. I just here for fun.
You just watch crypto stuff. All right. Just a little love for the chat here. We got a few new people in the chat. And now we got Julius San Gabriel. We got net lost cash something. Toro into the cosmos. Dougie, Napoli, Hefe, and Natalie. Uruguayan.
Natalie. Wait, Natalie what? Sounds an Armenian.
Ugarina.
Oh, that's not Armenian. Never mind.
Yeah.
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 That's in Netflix.
And Hefe. So.
Hefe. All right.
So to all of you, hola! Welcome to Sin City Crypto.
We have the man, Gareth the God, joining us in about 10 minutes. But before we bring him on, I want to move on to what can we expect moving forward, okay? And the first thing I want to show is our man, Mr. Jerome Powell, the chair of the Federal Reserve, speaking again at the Brookings Institute on November 30th in regards to stable prices and monetary policy moving forward. Here's what he had to say.
Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done.
This favorite line right there.
This is what everyone hung their hat on. This is why the stock market rallied. And he mentioned it might be necessary to slow down the rate of increases, right? And markets rallied. And of course, this is why we are expecting a 50-point rate hike. What are your thoughts on what he said moving forward? Do you see them, like, at what point do you think we're going to see a pause? At least a pause, not a pivot, a pause. Inflation under 4%? Under 5%?
A pause? Yeah, I would say under when it hits 3 point something.
No.
Because the target range is between 2 and 3%, right? And so if we get 3.9, 3.8%, as far as the CPI number, or at least the core CPI at 3 point something percent, maybe the real CPI, the larger CPI is at 4 point something. I could see that a scenario because right now the core was at 6, right?
Core is at 6.
Yeah. So core is 6. So it's down over a full percent from the headline. And so if we get the headline at say 4.7, and the core is at 3.8, I think that would merit a pause right then and there. And so I think that's my opinion. I do think that the dude doesn't have much, but beyond his word, you know what I mean? And he's been saying it for over a year.
They're just so
And
scared.
so at some point,
They're so scared of stagflation happening again.
yeah, and if he were to stop before he gets to 2 to 3%, that whole here get it till the job is done, that kind of goes out the window, right? Because he quits before the job is done. And so, I mean, I'm not saying it's not possible, but the dude would be lying, right? The dude would go back on his word if he stops the job before it's done. And that's something he just keeps echoing.
I think they're scared. What does the chat think? When are we going to get a Fed pause? If you want to throw a date out there,
Yeah,
if you
throw a
want to
month.
throw a percentage.
Throw a
out
month. Throw a
there.
month.
Maybe it's
So you got February. There's also another meeting in March.
Here. Actually, that's the next piece of topic we're going to talk about. So here's the FOMC meeting schedule. Of course, the FOMC runs for 2 days. The first day, they discuss monetary policy on both days, but the second day is the one we're looking at as far as the interest rate hike. So, like Robin mentioned, February 1st, March 22nd, May 3rd, June 14th, July 26th, September 20th, November 1st, and December 13th for 2023.
So we got a bunch of people here putting their input. Thanks guys for being active in the chat. We got Dennis says March, Property Sister says June, Crypto and Yogurt says February. Jason says first quarter, so he's kind of blanketing the pick there. It's an easy way out, Jason. And then you also got Ham City says May, and then Diener, who is also new, and CBD Suddy, who also is new, September 2023. Ooh.
Hey.
And you got Joshua Scott says May, and then Rob says March. So kind of interesting. I think it's anybody's good as a guess, right? And I think it's all dependent on how fast the CPI number drops. I think that no matter what, we're going to get a pause before June, because June was the all-time high, right? Where we had 9% the year before. And so for us to have a CPI print that is above the year before, we would have to have more inflation, or the inflation at that moment compared to the year before needs to be higher. And the car prices were up like 50%. And that alone, and then also the home prices were that's when the home prices were crazy. Remember when it was $500,000 was the average price for a home in the US? That's come down significantly.
It was nice because I had bought my house in 2020. But all right, staying on the topic of what we can expect moving forward.
And also, a big shout out to Jimmy. I just want to give you some love. 20 gifted memberships for
20 membership. So, Jimmy, our official hype man of Sin City Crypto. Now, before we bring the man Gareth on, we talked about and we showed you guys the FOMC meeting schedule. Well, what's important to know, guys, right? And if you saw the video we plugged in here from Kyler, you have the president of the New York Fed. Every year he gets a vote. And then it rotates between the other 11. And you get 4 new ones every single year. Next year, these are 3 of the highlighted ones that are of importance, I believe, that are going to be joining the FOMC. They all go to the meeting, but these are the ones that are going to be getting a vote on monetary policy. You have Patrick Harker from Philadelphia. He is considered a dove. He wanted a pause after 3.4 effective federal funds rate. He also warned on multiple occasions of over-tightening and overdoing. Then you have this lady, Lori Logan, which is the Fed president of Dallas, who's considered a super dove. She was extremely aggressive with quantitative easing in her district.
Is super dove an actual title?
Super dove. Let me explain. Let me put it to you this way. Her allotted QE for 6 months, she bought all that up in 1 month. So what she was supposed to do QE on, the amount of money in 6 months, she did it in 1 month. And she believes that the Fed should and can provide liquidity no matter the inflation, no matter the unemployment, no matter price stability. So she said, if the market needs liquidity, the Fed should do it no matter what. And that is why I brought up the credit card thing, the delinquencies.
This is the Super Dove lady?
This is the Super Dove.
Oh, okay. Hold on.
Then,
Yeah. What's up, Boothang?
you're an idiot, dude. You're such a moron. And then, Rocco, could we go? That's pretty funny, actually. Then you have Mr. Charles Evans, the Chicago president. He's actually considered a hawk. He is okay with over-tightening, and unemployment is no concern of his. So essentially, if rates are going up and unemployment starts to go up, he doesn't care, as long as price stability stays the same. There's a wild card, though, and that is Minneapolis Fed President Neil Kashkari. You might have heard that name. He is a flip-flopper, okay? And here's a video from him explaining inflation and what they thought was transitory a few short months ago.
When inflation started to take off after the economy was reopening a year ago, I thought, and many of my colleagues thought, this is likely going to be a temporary effect. You know, we had the service sector of the U.S. economy shut down. Households had a lot of money because they've been saving money. There was a lot of transfers from the government in terms of fiscal stimulus. They were not able to spend that on restaurants or on travel. So that was getting spent on goods and products and washing machines. And you saw really high inflation in the goods sector. So what I thought was going to happen was that as the economy reopened, people would shift their spending away from goods towards services, and the economy would return more into a balance. That has not happened as quickly as I had expected, and you've seen prices climb and climb and climb. So in response to that, the Federal Reserve has moved very aggressively to say we have to do our part to regain price stability and then get inflation back down to our 2% target.
I mean, the question is, there's a new normal going to be unlike this normal that we've had where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that. It'll sort itself out. Oh. You know, a supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s where there will be
my apologies, guys. Our mics are muted, but we're good. You should be able to hear us now. So just to kind of put a bow on this thing, Jerome Powell is talking about moving forward monetary policy and kind of a new normal we can expect. And so I'm just going to rewind this. And then right when we come out of this, we got our man Gareth coming on. So here you go.
I mean, the question is, there's a new normal going to be unlike this normal that we've had where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that. It'll sort itself out. You know, a supply shock from.
No volume. Rocco, will you turn the volume up, please, on the laptop?
We're good. We're good.
There's no.
On the laptop?
It's muted. The laptop's muted.
We're good.
All right.
Oil prices or whatever. Are we going into a situation a little bit like the 70s where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. I mean, it's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it and to keep inflation expectations anchored.
So moving forward, right? 2% is a number. They're sticking with it. 2%, 2%, 2%, no matter what. 2%, no matter what. 2%.
Do you think 3%? I still think 3%.
I think they're going to move that target up, man. They're going to have to.
They're going to move it up to 3, right?
2.5. 2.5. I think at least 2.5. I don't know. I'm curious to see what Gareth thinks, which, Rocco, let's go ahead and patch him in. Oh, Gareth the God Soloway.
Yay!
Oh, jeez. How you guys doing?
Good, my friend. How you doing?
We're suited. We got
Good,
ties on
very
today,
good.
man. We
Yeah.
got ties on.
I know. I'm not used to this. I feel uncomfortable.
We're trying to look as good as you, okay? We're trying to get on your level, my friend, but we can't. Gareth, first and foremost, thank you so much for joining us. I can't imagine anyone who doesn't know who this man is, but this is Gareth Soloway, in the money stocks, a legend in our space, in technical analysis in general. So, Gareth, we appreciate you joining us on our very special FOMC show. So we ended the video on this, and I'm curious to get your thoughts before we get into the charts. Do you think... They keep saying 2%, 2%, 2%. That's our goal, 2%. Do you think that goalpost is going to move up to maybe 2.5%, 3%? Do you think they're going to be forced to do that?
4%? You never know.
What are your thoughts?
Yeah, I actually do eventually think that's the case, right? So, right now we have a strong economy, so they can stick to that 2% and say, hey, listen, no big deal. We got to push it down to 2% before anything can happen. But tell me it's going to be 2% if we're in a Great Depression, right? Obviously, at some point, there's going to be a tipping point where the economy is so weak that they're going to say, all right, you know what? 3%, close enough, 2.8%, whatever it may be. Now, will it be 4 or 5%? I mean, probably hard to imagine that, because remember, as soon as they start printing again, inflation probably starts to rise again. So I think 3% maybe, but hard to imagine at 5% they would.
Fair enough. And I want to give a quick shout out to Blockchain's Dave. It said Gareth is fired. Did a $10 super chat. All right, Gareth. With your experience with these FOMC meetings, rate hikes, are you on the same page as we are? 50 basis points.
Yes, 50 basis points to me, foregone conclusion. It's all about what they say, right? So the statement comes out at 2 with how much they hike, and then the key is going to be, what do they say in the statement, and then the press conference at 2:30. How does he tweak that when people ask him questions?
What's your kind of expectations when these numbers drop? Well, like, what have we seen in the past, and what do you think outside of just sheer volume and trading? I know we've seen giant spikes up and then giant candles retracing right back down. I feel like they're dissecting every word that he says in the press conference. What do you forecast as the movement of the markets after the rate is announced on the short term?
So you're right. The initial thing is the algos read every word that comes out and they react to every word. So like if it says something hawkish, they're going to react in one way, and all of a sudden the market's going to pop that way. Then they get to the second word in the statement and it could go the other way. So you usually do see this really kind of whippy up-down move initially. But then within a few minutes, you'll see the beginning of a general trend in that announcement.
Let me pause right there. Did I hear right? So basically, you have bots trading just off of words spoken.
Hell yeah.
That's the thing that happens now. Institutions have these computer programs that anytime news breaks, they scan immediately for a set of words, right? And if it's like nuclear war, all of a sudden, right? Imagine they scan that and they see that, it's going to be like they're going to automatically sell the market. So that's the initial reaction. And then what you usually see later on is the digestion of the actual information, where people say, wait, is that really what they meant? What are they, this and that? And that can be the next move that comes in around 2:30 or later.
All right, Gareth, let's get into some charts here, if you don't mind. What's the, I don't know if you want to do NASDAQ, Dow, or any traditional, let's start with macro and traditional finance, traditional markets. What are we seeing? What do you expect to see? Are there any price targets, maybe some entry or exit points that you're personally looking at? And just kind of leave it general for that.
Yeah, so let me show my charts here and get that underway. Bear with me as I do that here. There we go, toggle screen. Perfect. So what we have basically, this is the S&P 500. And one of the things that I think we should pay attention to, I'm going to get rid of some of these extra trend lines, is that right now you have the S&P. This is from the all-time high on the S&P to the second pivot, to the third, to the fourth. And then yesterday we had that wild gap up on the CPI and we came right back below. So going into this is a huge level. If it breaks, it can free the market for a short-term rally, potentially maybe all the way up here to around 4,200 and change on the S&P. But you have to respect resistance. And again, markets are underneath this line. And every time we hit this line, we have a bigger sell-off. So just be aware of that. You know, in terms of bias, I'm always bad at guessing what happens when the Fed comes out. So I'm not going to try. I can just tell you guys that we're at resistance. There's a chance that we could break it, but until it does, you have to be a little bit on the careful side here.
Okay. What about Bitcoin?
Let's take a look at Bitcoin here. Now, Bitcoin, number one, this is just a classic case of awesome charts, right? So what I mean by that is you had this move up, and then we had this beautiful bull flag. This is what's called a bull flag when you go sideways and consolidate. And that bull flag, just like the name says, it means that the probabilities are telling you there's a move up coming. And we've gotten that move here. Now, in terms of upside, like where the heck could we end up going? The biggest thing to me, there's going to be a big resistance coming up here that's right around 18,500. You can see how, number one, how all these lows right along here, they kept on hitting it, bouncing until we broke on the FTX debacle. So what you have to understand is that once support breaks, and it was clearly support over here, this now becomes resistance. So if Bitcoin pops here, it's got to fight through the 18,500 level to really get the next leg up. And so right now we're coming into resistance on Bitcoin. We'll see again what that means for the Fed statement.
Now, you know, you've been doing this for a very long time. It's also important, right, to make sure that when we do break these levels, you want to retest, correct? Is there any scenario where if there's maybe enough volume or whatever the case may be, where we don't necessarily need a retest to kind of secure resistance as support now?
Yeah, so you're right. You're right. In general, when you break above resistance or you break below support, there's this tendency for the market to check back to that level. It's kind of like going back to what I call the scene of the crime. Right. It doesn't always have to happen when you get these explosive moves. But again, looking at charts is a matter of probabilities. I would say about 70% of the time it does check back to that level, which, by the way, you could arguably say that's what's happening here, right? Here you broke support, and now look at what we're coming back into. We're coming back into the scene of the crime right at that level there. So that's why this is going to be such a big level, because most of the time, this is a bigger bearish flag versus the small bull flag here. Most of the time, this would be the move on Bitcoin that should occur. It doesn't mean it will have to happen here, but I think investors need to know probabilities, and probabilities are favoring a hit of that line, and then we should start to move down again off of it.
Gotcha.
And that price level is 18.3. Is that what it is?
18.5. Yeah, 18.5.
Oh, 18.5.
What's the
we're
Dixie
just, I mean,
looking?
literally we're at 18.3 now. It certainly doesn't give us a lot of upside here. I'm hopeful that maybe, you know, the greatest Fed statement could just rocket us through that level. But again, you know, it's we'll have to see if that's the case.
What about the DXY?
DXY here. Let me take a look at the dollar. I'm just actually getting
Is that something you follow closely personally, Gareth?
Yeah, I do. I do follow the DXY, absolutely. Because again, it's had such a big impact on the overall market, right? So when the dollar was going up, generally it's pushing Bitcoin or putting pressure on Bitcoin and cryptos. It's also putting pressure on gold, silver, as well as the stock market. So you can see the dollar's actually falling here on the daily chart. We've actually come in quite a bit. And then, you know, the one thing I would just point out here is you haven't seen this in Bitcoin because obviously Bitcoin has other issues like the FTX debacle. But if you look at this drop in the dollar and then flip over to the S&P 500, look at the corresponding move up in the market, right? It's basically a 1-for-1 where when the dollar goes down, you generally have a move up in the S&P. So I do follow the dollar absolutely, as again, it does have an impact on the market. By the way, we are now, what are we, less than 3 minutes away from the Fed statement?
Yep.
Yeah, we'll be following that in real time and kind of reacting to it.
Awesome.
I do want to bring in our second guest for today. He's been on our show once. I'm pretty sure you're familiar with him as well, Gareth. Magic Internet Money. Let's go ahead and let's go. Magic, what's up, man?
Hey.
As you guys say, is it hola there, right? Yeah.
Hola,
How we doing?
hola.
You gotta say it really annoying though. You gotta say it extremely annoying. Man, what a privilege it is to have these two guys on the show with us. Thank you guys so much, guys. Magic Internet Money, go subscribe to his YouTube. Also, go follow Gareth in themoneystocks.com. Those links are in the description of this video. Magic, I want to ask you the same thing I asked Gareth. We're 3 for 3 right now. 50 basis points. Are you going to be the fourth?
Yeah, 50 I think is kind of the expectation.
Okay, and then where do you think we'll see a pivot? Do you think with the treasuries, with this the U.S. securities kind of market, with everything going on, inflation coming down, do you think a pivot soon is near, or do you think it's gonna? I mean, what are your kind of thoughts?
Define a pivot, I guess is my question. Are you talking lowering interest rates again, or are you talking just cutting rates? I think you're not going to see that till 2024 potentially, maybe as late 2023, but I don't think you see that in 2023 most likely. Personally, they did just release a new dot plot today, did they not? I think, and the dot plot was showing for 2024 to be the first rate cut. And I think it was going to be like a half a point or something like that, if I recall.
Okay. We saw a Bitcoin and I believe it was an S&P chart from Garrett. Do you have any Nasdaq, maybe a Nasdaq chart that you kind of want to show, or
yeah.
what do you expect to happen when this number comes out in about 1 minute here?
I think Gareth covered it best. We talked about trying to prepare our members for trading this today, and that was going to be prepared for a sharp move up or down or both at that moment, because that's been the trend thus far. Let me get my screen up for you real quick here. So just looking at like this is what I track. I track the SPX, DXY, a little bit of ICIX. I keep it really, really simple. I prefer regressions over trend lines because this is kind of a custom tool that I've doctored a little bit to capture trends. And so for me, as I'm trying to capture the trend, I want to see when we're breaking out of it. So if you get a move out of this, you've already actually come down to your overall golden pocket from high to low here, from your Corona crash, basically, right? So this is a huge moment of support, and you would essentially be looking for a reciprocal move to the upside over time. Now, there are levels in between there that you would want to see broken. Specifically, going to be looking for about 12,829 if you're going to get any kind of a real movement out of this asset class, right? So that's what I'd be looking for. It may not happen immediately. If it shot all the way up here, obviously that's not going to happen in the stock market. But over time, if you can break out of this and make that move up, that's what you want to see. To the flip side of that, if you get a false breakout like you have in the past and you start breaking below your Q4 low, you're probably going to retest not only the June lows, but the lows that you made back in October, in my opinion. I work off horizontals primarily, and I use very few indicators. So that's how I'd be trading it right now.
All right.
Awesome.
Breaking news. We got the numbers out. So the federal raises the interest rate by 0.5 point. So right in line what we were expecting. So 0.5 percentage. This is the highest level in the last 15 years. Just a heads up on where we're at now on the federal funds interest rate, which is I think is at 4.75 right now. We should be expecting lots of volatility in the market as as traders try to digest the news. And next up is the press conference, which should be up in the next 30 minutes or so.
30 minutes or so.
30 minutes, and then from there we'll see even more volatility in the market. So
now I want to throw back to Magic here. Magic, now that 50 is in, are you expecting a lot of volatility? We saw in the crypto markets the volume was right around 34 billion, which is extremely low. Are you expecting that number to go up substantially? What's kind of your overall feel now that we know that 50 is in?
Yeah, I mean, a lot of times there is a lull, and if I'm not wrong, there's a lot of options expiring at the end of the month that are all coming in around like 17K. And if you actually start to look at your overall averages, they're going to be preset for the next upcoming quarter and month and things like that. You can see it's all around this like 18 to 17,500 region. So it's really going to put a lot of emphasis on if we are going to get a move up. I feel like we're going to be in this area regardless. We're going to come back to it, or if we get a move down, we're going to come back and back test it again. So as far as volatility and price action goes, really not unless we start getting through about 18,500. To be honest with you. So
we are seeing a pull. As I say, we are seeing a pullback in the price of Bitcoin. It's down to 18,166.
Yeah, this is what you should be expecting. Actually, sorry not to interrupt. This was
you're fine.
I have it under my fun tab, but I was looking for specifically. I'll just draw it up. We were looking specifically at a channel. Basically, you're looking for this trade, and you've pretty much hit the 1-to-1 at the high, come back to the E2, and now you're looking to see if you're coming back to that December open. So you really want to see that December open hold. If you go out to a monthly time frame, you can see that you've already come up above the Q2 low. On a 3-month basis, you
Hey,
can see
real
this
quick,
level.
Magic, real quick. Either Gareth or you have a speaker on in the background. We're getting a lot of feedback. I'm not sure which one of you guys it is, but if you mind turning it down a little bit.
Yeah, I'll mute myself, see if that helps, all right?
Okay, cool. Go ahead,
Check,
Magic.
check.
Yeah, you're
Oh, yeah,
good.
we're good.
All right, we're good. Okay, so basically what you're looking at is if you went to the 3-month time frame, so this is to keep it as simple as possible for people. You want to see that these wicks become support. So you want to see traders being trapped down here. So these are people that are exiting positions or opening new positions, unfortunately, to the downside. And so what will happen is they'll start filling larger limit orders, and people will essentially start attaching themselves to new market orders as they enter. And that's usually good cumulative delta and positive longs coming in. To this time, we've really only had a short squeeze. We haven't had an actual new trend start in terms of buying. So you want to see this monthly open get defended at a minimum. If you start coming back below 17,148, it's going to be problematic. So you are going to see a little volatility, but as long as you're above 17.5 in the medium term, this trend can actually continue, and I don't see any reason why it wouldn't go as high as 19,150, maybe even higher. That's going to take some time, obviously. So when we say volatility, it could take weeks to months. So when I say that we could be boring for a few weeks here, as long as we're living in this zone, it's still okay. But yeah, the trade today was a really simple channel trade. You can already see it's getting a buyback up, but realistically, the back test of your range is actually coming in at about 18,620 to 18,695. And if you looked at the 1-to-1 reciprocal move of it, it's 18,591. So you are trying to set up support here at that gold pocket and make that move into this zone. And then that's really where I want to start gauging the reaction. But this was a nice day trade for sure.
Okay. Hey, Magic. I think your chart is frozen, my friend. Not sure if you want to.
Yeah, that is unfortunate.
All good. Here's what I'm gonna do. I'm gonna swap over here, and let's take a look at what crypto is doing currently. So you have the volume did tick up just a little bit, sitting at $37.6 billion. Bitcoin is now under $18,000, down 0.73% over the last 1 hour. ETH down 1.23. The biggest losers over the last hour are going to be Toncoin, Trust Wallet, Tezos as well. What is the I'll swap this over to Gareth. What's the traditional market doing? Is it moving like you expected it to? Is there anything that's kind of an anomaly right now? Maybe a sector or a certain stock?
Yeah, so really what I'm seeing here, and I'll flip up my charts here as well, is that basically when that announcement came out, the S&P took a nosedive here, and you can see this big red candle. And what that tells me is that it's not the 50 basis point hike, right? People have to understand that the market already knew that was coming. There was something they always release like a statement accompanied with it. And it must be something in that statement that was a little bit more hawkish than the market was anticipating, and that's why you got this sell-off on the S&P 500. On the spiders here, we went from basically 405 all the way down to 399, which for a 10-minute candle, this is a 10-minute candle, that's a hefty drop. It is getting a little bit of a bounce here, but nonetheless, there's something in that statement that's a little bit more hawkish than anticipated.
Interesting. And we should, he will be speaking in about 25 minutes. Of course, I'm speaking about Jerome Powell. So you guys expect a lot of volatility during and after his speech, correct?
Yeah, absolutely. The biggest thing is, so what I've always noticed is Jerome Powell, they put out the statement, they see how the market reacts. A few statements ago, the market was rallying tremendously, and then Jerome Powell didn't want that, right? Because the higher asset prices go, the harder it is for inflation to come down, because people feel richer. When they feel richer, they go out and buy that new car, and basically it stimulates inflation. And so he came out in the press conference and was the opposite. He was so hawkish, and the markets then took a nosedive. So there's always that chance where you could see a total reversal in price action during his comments.
So do you think, so what you're saying is that he perhaps has two different speech lineups, or two different baskets of answers for questions that he would have, one being more hawkish and one being more bearish? I mean,
yeah, I'm not sure if it's, I think for the most part, the Fed wants to make it clear that, hey, listen, we're going to stay the course here until inflation comes down. But I'm sure that there's specific words he can use that would shock the markets more than other words, right? And it's the difference of literally replacing one word with a slightly more harsh word. And then all of a sudden the algos, like we were talking about, and investors freak out, oh my goodness, he used that word. Oh, so yeah, it's like that. Yeah.
That's funny. All right. So we talked about liquidity in the market. We showed the M2 money supply that's going down. Interest rates, of course, are going up. But Jerome Powell, in his speech at the Brookings Institute, if you missed it, he spoke about there's plenty of reserves in the system, which is good for liquidity and which is good for just the public in general. What kind of effect, Rob, do you think this 50 basis point rate hike is going to have, maybe on the M2 money supply, maybe on what the Fed does with the balance sheet? Are they going to stay the course? Another thing is as well that I'm going to ask each one on the panel here is the bank reserve, fractional reserve rate, which is what percentage of their deposits or their liabilities do they have to keep in the bank? That got chopped to zero back in March of 2020, and it's still at zero, which means if they don't have to hold 5% at their bank, right, as part of their reserve requirement, they are now free to lend that 5% out and make money on it. What do you think that's going to change? And I'll start with you first, Robin.
Well, we're getting to an interesting point here. And so we're at 4.75% federal funds interest rate, which we're getting that much closer to that big 5% mark. And I remember when we started raising interest rates, there was this large community, or just a lot of sentiment was, hey, if we went over 5% federal interest rate, the economy would break and we would collapse, and there's no way we would ever go over 5%. And here we are at 4.75. And if the federal funds interest rate increases again at the next meeting in January, February, then even at 0.25% interest rate hike, you're going to be at the 5%. And so my question is here that, these interest rates don't play through the system immediately. And we're seeing the effects of this down the road, 2, 3 months, 4 months. You're starting to see layoffs later on down the road from when they started increasing interest rates. Is 5%, is that the doom and gloom number? Because we're gonna get there unless the Fed straight pauses in February, completely doesn't raise it at all, which I don't anticipate. I figure we're gonna have at least a 0.25 in January, February. If there is no pause, we'll be over 5%. We'll be at 5.25% perhaps. And what does that spell for the economy? I mean, do you forecast, Gareth, the macroeconomics taking a pullback? I know we had discussions about perhaps in the S&P 500 that we had bottomed, and perhaps it seems as though we might be out of that path. Or do you think that going over 5 is going to test our local lows in the S&P 500, which we saw, what was it, like 2 months ago?
Yeah.
Yeah, I think that, the 5% is the Fed funds rate. I think the biggest thing for the economy is what is the 30-year mortgage, right? Because that's going to be generally what people are going to be getting if they're going to look to buy a house. And we've already seen the housing market come to a screeching halt. And just think about the chain reaction, right? The plumbers, the carpenters, the electricians. I mean, everything goes through that housing market. So the economy there's no doubt that we're headed to a recession in my camp. just based on the interest rates even being where they are. At this point, I think any additional hikes, and my guess is they'll do a 25 basis point once in 2023 and then probably go to net zero, no more hikes at least. They're not going to cut, but no more hikes. But I think that, I would be shocked if we get above 5% on the Fed funds rate because I don't think the economy can withstand it.
Amen, Gareth. And I've been preaching that for such a long. I don't even think, my range is like the max, absolute max, 5.5% to 6%. Because as interest rates grow, as interest rates get higher, you got to understand servicing debt becomes more expensive. And at some point, you can't make those interest payments and you need to raise money through treasury securities to keep your economy going, America. So it's bad for a lot of different reasons. I want Rob, ask Magic, can you answer the same question, which was what, Robin, if the bottom for Bitcoin and what you can see?
No, the traditional markets. Is the S&P 500, did it bottom? Because I think it was a couple months ago. It was at its local low. So what's your vibe on legacy finance?
I think it's too early to call for a bottom personally. In terms of the chart, it's run right into resistance. It's reclaimed no major ground at this point. And to me, this is a sentiment trade at this point. Everyone's been hyper bullish coming into this event, thinking 50 basis points is going to be great. So this does have the setup that if they wanted to, trap some traders, do things like that, they could, and fill larger short positions there. That's traditionally how they're going to do it. Now, personally, I would prefer higher for that because I would like to prolong this type of a setup in traditional markets. I think that it would be more apt to say that we maybe get that move back down in the summer, but you don't always get what you want. So no, I don't think that the bottom's in. I think it's way too early to call that still, especially if they're still doing easing. Like obviously we're talking about them pausing that in 2023, which I think is likely. Well, they'll pause raising rates because they need to see the effects, which they should be able to do. But I think the biggest mistake will be is if they pause and then they start the money printer back up too early, or they cut rates, however you want to put it. That would be a disaster because you would get that sharp move up and then down as well. So I honestly don't think that the bottom is in. I really don't. There's no reason. The trend hasn't changed. I think it's a timing game. I think time is, I'm fairly new in terms of the trading game, and I've been trading for almost 5 years now. And I think there's a lot of people, even including myself, that are learning a lot from these events because, just because you've been trading 5 years doesn't mean you know everything. So I'm soaking all this in as well because this is one of the first time I've had these events. But I think it's a big mistake for people to be just jumping on bandwagons of bottoms this early, when these things can really get drug out for quite some time. And I say quite some time, 6 months is a long time. But it's really not, and it's funny to me how in just a few short months, people's opinions can be swayed so quickly to the point to where they're putting dollars on the line. So, yeah.
That's very, very well said. I do want to. I know Gareth mentioned the mortgage rate being a very significant factor when it comes to the U.S. economy. It was only a month ago we had the national average for the and I have a chart here pulled up. So the national average was 7.3% back in November. We are down to 6.28 right now on the 30-year fixed. And so, what is the implications of the 0.5% interest rate hike? It's I'm curious to find out where this is going to go because we've been trending down. So yeah.
So they did release. We want to swap over to mine here. Here's what's changed in the new Fed statement. I'll swap over to mine here. Here's what's changed in the new Fed statement. So this is a statement that came out directly. This is what Gareth was referring to. In here, they talked about the war, of course, the Russia-Ukraine war. Related events are contributing to instead of creating additional upward pressure on inflation and are weighing on global economic activity. I want to ask, and of course, this is going to be a hypothetical question. Let's say the war in Russia and Ukraine are over. Do you think that'll do enough for inflation to get risk on assets to just screw everything that's happened? The Fed's gonna at least stop or pivot, and we're gonna breeze off in the next bull market. What are your thoughts on that? I'll ask Magic first.
Could you repeat that real
Did you
quick?
say
You cut out there.
Oh, sorry.
So that's okay. In the Fed statement, they talked about how the war is contributing to the upward pressure of inflation. My question is, of course, this is opinion. If that war does come to an end and the supply chain and the wheat exports from Ukraine, price stability comes back into play, do you think that's enough of a catalyst for risk-on investors to say, all right, we're back in? Everything's going to be fine.
Maybe. Yeah. I mean, you'll probably get a pop off of it. I can't imagine you would get an event like that and not see something positive come of it. But I can't remember the correct term. I think it's pull demand or demand pull inflation is what they're referring to, where you just have more demand for goods that can be basically provided at the moment because of supply chain issues. And so that's just a fundamental thing that's going on. And I imagine the war on Ukraine is affecting that. I do think that it's a little foolhardy to maybe say that that's the only thing that's causing it. I don't think maybe that's what he's saying, but it's almost implied that's how people are going to take it. They're going to say, yeah, that war on Ukraine is really doing all the damage here, when there's other things at play. But like you talked about it earlier, one of the big things is wages are going up. And if wages are going up, it doesn't help that pull demand relationship because people have more money to spend and they're willing to spend more on products. So there's, more demand for them and they're willing to spend more because they have more money in their pocket and jobs are, still being sought after. So it's kind of there's a lot of moving parts to it, I think. It wouldn't be a bad thing if the war ended by any means.
It has been the narrative though with a lot of politicians when assigning blame for the incoming recession or their denial of it's coming or just where we're at economically. They do like to point the finger at Ukraine. So.
Has a politician ever come out and said we're going into a recession that wasn't, trying to slander the other side? You know what I mean? None of them want to say it if it's going to happen. They could know it's going to happen tomorrow and they would just be like, it's never going to happen, guys. Don't worry. Funds are safe. And then the economy tanks the next day. They're not going to come out because it would cause panic. And it's not good for business. So.
What are your thoughts, Gareth? Same kind of question to you. Will the end to the war, will that be enough of a catalyst for these investors who in the stock market and risk on assets like Bitcoin would be comfortable enough to get back in, based off of, your experience in trading and big things happening in the macro sense?
Yeah, I would say for me anyways, it would be that short-term relief rally, but it would probably be very, very short-lived. And the reason I say that is because, ultimately we have to look at the bigger factors here, which are the global economy, the domestic economy. And the war at this point is now becoming more the norm. It's become something that we've become accustomed to, unfortunately, but really it's all eyes on where is inflation. And like Magic said, that's wage inflation. It's wage inflation then permeates through paying people that are picking apples more, that are doing this and that more, and then it goes into food prices. And so there's a lot more than just the war. Yeah, the war does have an impact on certain things, like grain. Obviously, Ukraine produces a lot of grain, but it's only one component. And I think at this point, hiking the Fed funds rate from 25 basis points to almost 5, that's going to have reverberating impacts on the market, on the economy. And I don't even think we've seen any of that yet, right? I mean, the lag effect for interest rate hikes is 6 to 9 months, which means you probably haven't even felt the last 275 basis point hikes yet at all in the economy. And so that's coming. And you could see it, by the way, Meta's laying off 20,000, almost every day there's another company announcing layoffs. It just hasn't really filtered through to the jobs numbers, but it will. It's coming.
That's an interesting point. I guess my follow-up question, Gareth, is if the Fed knows that it takes, I'm assuming they know it takes 6 to 9 months for it to make its way through the system. Why are we continuing to, wouldn't it make sense to pause and see how it does play out in 5 to 6 months? Or
well, historically they tighten the wrench until it breaks, and then by then it's way too late. Like that's right. How we got into this mess.
Unfortunately, that's their MO. They just like with transitory, they were totally off base. And I think we have to remember that, yeah, these guys are good economists maybe and stuff like that, but they're still human beings. And I think they still get kind of carried away. Like the fear of COVID probably made them overreact with stimulus. And then now you have the other side where they were wrong on transitory. They have egg on their face. And so what do? They overcompensate the other way. And it's just like, it just keeps going back and forth here. And the economy is ultimately paying the price. So I do think that in general, they're aware of that, but they probably are saying, hey, listen, would we rather tighten too much and force a recession or not tighten enough, and then inflation gets out of control again. And I think they're going to err on that harder course versus the weaker course. Because again, in the 1970s, Volcker, right, they stopped raising after a while, and they kind of got lax, and then inflation came roaring back. And Jerome Powell has definitely kind of referenced that and said, hey, we don't want that to happen again.
I don't think, for people that are afraid that they're going to go Volcker and go above what inflation is as far as the federal funds rate, that is not possible. I just want you guys to understand that. Go ahead, Rob.
Yeah, so we're starting to see some volatility in the markets. What is I guess I'll start with you, Gareth, and then I'll send it over to Magic afterwards. But what is the charts telling you right now as far as, Bitcoin has pulled back $400? So I'm looking at a chart here, a massive red candle back the other way. What are the charts telling you?
Yeah, so I mean, this is kind of what we discussed just before coming out, is that we had to respect this retrace to the scene of the crime. It didn't quite hit there. That was about 18,500, but it got to 18,375, and now we're starting to come in here. So let's hope, obviously I think we generally prefer Bitcoin go up for the most part. Let's hope we're not starting to see that next leg lower, which again, this bigger pattern is suggesting. So here you had the break point of support. This was now broken. Now it's come back to retest that, and usually, again, probabilities signal a down move coming in.
Are you seeing any trade opportunities when it comes to Bitcoin? Any levels that you think might be a good time to get in, or are you just kind of steering clear of something as volatile as Bitcoin, looking more into like index funds? What are you looking on the trade horizon here for the next couple hours?
Yeah, I mean, so I've done, just since we've been on, I've done a few trades in the spiders, which is the S&P, just in and out, kind of quick jump ins. Generally, I think Magic is the day trader when it comes to crypto. But the one thing you can see on here, which is just fascinating, is that look at the high of this consolidation area, like right through here, and then look at the low on Bitcoin. It went right there and bounced. So again, I'm no day trader on Bitcoin, but that was a good technical level right there. Now it's starting to come down. Next spot on Bitcoin for me, I would be looking at around 17,630. That would be your next support if this first support breaks.
Amazing.
And then for you, Magic, what are the Bitcoin charts telling you as far as a trader? Is there any spots that you're looking to get in? Is there anything that you're kind of fearful of, support and resistance levels? I mean, we were seeing big moves.
Does this look like a man who gets scared? No.
It looks like some big moves in Bitcoin right now. So
I'd say I've been holding a short for almost a year now, so it's one of those where at this point I'm pretty selective on when I'm going to get involved. So if we take a look at the chart, this was kind of the level you had to be back above. I had 18,591, so very close to Gareth's 18,500 resistance. But what you ended up doing again was just you came up, you had a really nice channel. You're just trading this for what it is at the time, and I have it on my other computer. Basically, the order flow was showing that people were taking massive profits into that. And then as the move got underway, what you want to do is, our job isn't to predict the market, because we're not the market makers, believe it or not. Some of us have quite a bit of money, but we're not making the market. So what you saw market orders confirm the directional trend, meaning that you had sell imbalances to the downside as it was breaking support, telling you that this move does have legs. Now, in terms of levels you have to hang on to, it's kind of funny that it lines up at the bottom of this channel. It's something that's so simple. But again, that December open is just such an important level, and I'll show you why on the weekly time frame as well. If you were to come over here and just take a look at these weekly candles, you can see right here, this is where you had basically been held down for about 3 weeks, and then you came above it and you actually support flipped it. So I'm going to delete that one. Then we're going to go down to daily, and this is a very simple trick. These are just swing failure patterns that you're identifying, right? So you've got one here as well at 245, and I already have these boxed off because they were already on my chart. Right here, I'm going to change the color so you guys can see it a little bit better. And let's amplify it. There we go. Hopefully that's a little bit more clear. So essentially, if you come back to this December open at 17,148 and you start losing this level, this could be very easily looked at from just an overall swing fail level, and then also support and resistance flip, that if you lose this, you're probably going to come back to these lows, in my opinion. So if I was someone that was looking to get in, This would be an area that I'd be interested in, but I would be cautious because if this comes through this level, you're back inside this overall range, and then the game you get to play the game all over again. And typically speaking, when you get a range like this and you start breaking down back in it, you're not going to just come back to the point of control. That's your natural target anytime you re-enter a range. You're probably going to rotate the whole thing because you've trapped people above the range. You've got the most transactions here. Now you've got, the fuel to take it to the downside. So you really, you don't want to see this level lost. I think that is I think if we get down there, it's probably not great. So kind of what Gareth's saying, 17.6, I've got somewhere just beneath that at like 17.567. I kind of stick to that, major quarter two low area that if you want to see Bitcoin continue to push up, you need to see 17.5 basically holding as support. Maybe a wick basis down to like 17.148. But after that, I'm probably going to be more selective and wait for the market to determine a directional change, and then I'll be happy to jump in there. But yeah, that's really all I've got on the local Bitcoin chart.
Guys, if you enjoy TA, if you're thankful these two amazing guests are joining us, hit the like button. Also, go support them. All the description and the links are in the description of this video. Gareth, let me ask you a question. So, with your experience being in the markets, right? Bitcoin halving, we see a run up, maybe 3 to 6 months prior, hash rate goes up, and then we see a little bit of a pause or kind of a move to the downside. When the halving comes around, March, April, or May in 2024, and we're still in a restrictive monetary policy from the Fed, is the halving a big enough event to where it can say, I don't give a crap what macro is doing, what the Fed is doing, we're still going to rally? Okay, you got to unmute yourself, Gareth.
My fault. I had myself on mute there. But yeah, I do think it'll have an impact. So the biggest things for me in the crypto industry is, number one, we have to get that transparency through some sort of regulation, right? And again, even myself, I'm really kind of hesitant on investing more money in Bitcoin or anything else until we have some ground rules that we know, the rules for exchanges, the rules for tokens and everything like that. So I think that's number one. And then that alone will start to potentially put the bottom in Bitcoin and some of these cryptocurrencies. And then what you do is you kind of say, okay, as we get into 2023 and the later portions, let's say the economy slips into recession, then you get to a point where you're saying, all right, now where is money going to be invested? Because institutions have to put money places. And I think the dawning of this transparency and regulation in crypto, it probably makes crypto, at least Bitcoin specifically, maybe Ethereum, become very attractive. And I think, again, that can actually create Bitcoin or make Bitcoin the asset that actually can go up even when the equity markets go down. Right now, we know the assets are correlated, but I do think there's a change coming, but it needs that transparency first.
That's interesting. I want to get Magic's take on this. Magic, same question to you, and then I'll ask our friend Robin here. Do you think with the halving cycle, what it's done in the past, do you think no matter what kind of monetary policy atmosphere we're in, let's just say we're still super hawkish, we're at 5%, terminal rate, do you think that the halving is bigger than all of that, bigger than any macro happenings that Bitcoin would still do what it usually does?
I think it's a little bit naive to put all your weight on one factor of the market, just because it's one of those things where the halving will have an effect. It's a supply shock, basically. And this is one of the few assets that, diminishing supply, it's one of the things that makes it attractive. So of course it's going to have an effect on it. Supply and demand is a real thing. But I'm in the camp with Gareth. We talked about this on our channel not that long ago, where when's the bottom, and we both kind of agree that regulation has to happen. And FTX really brought that to light, whether it was an inside job or not. I've seen a lot about that these days, but yeah, I think that's coming. And once we get clarity on that, and maybe even something like a spot ETF over here, then you'll see, not only the bottom, but I think you'll see the spectacular rally that people are looking for. And that could take a long time because our government doesn't exactly move quickly, unfortunately. Right. So it is what it is.
All right, we got
Here we go, guys. Jerome Powell, let's go.
Let me just turn my sound on here.
We understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated.
David, are you hearing
Job gains have
anything
been robust,
that stands
with
out right
employment
now?
rising
Yep.
by an average.
Any big words, or I know we were talking about like.
Well, I'm curious to hear what he has to say, but
Okay.
Oh, sorry, my bad.
The labor
So Dow
with
is
demand
tanking,
substantially exceeding the supply of available
down
workers.
4.3%.
The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
5.1?
Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
What are your guys? So just right off the rip, Gareth, is that something that's going to spook the markets? Is that something that's going to maybe bring some more clarity? Like, what are you feeling here?
Yeah, so I mean, the biggest takeaway I think is that he basically is saying that rates will have to remain high for an extended period of time, even though they're kind of coming to the end of their hiking cycle. Don't expect essentially for rates to start to fall as soon as the economy starts to sputter a little bit. Excuse me. So I think that's my takeaway. And I think we saw the markets dip again when he was making these comments. We are starting to bounce a little bit. Bitcoin's starting to bounce a little bit off the lows, but still well below 18,000. But I think the market's just happy his comments are over, right? It's like a relief. Although right. Now he has, there's the press corps, lots of journalists will be asking questions now.
Yeah, we'll be switching back over there in a second. Just wanted to get our first knee-jerk reaction.
What are your thoughts? What are your thoughts, Magic? Same question to you.
Yeah, so very, very similar. I think we kind of all knew this coming into it. They're going to stick to their guns, and they were probably going to say things like, we have to steady the course. He's said that, I don't know in how many of these press conferences. So, yeah, I mean, like I said, I don't expect them to pivot or actually lower rates, I guess, until 2024. That speech was pretty indicative of it. Unfortunately, what Gareth alluded to, where if the economy sputters, they're not going to lower rates. Like they're saying, they're not going to take their foot off the gas. That's why you see the crashes after a pivot takes course. Like when they say pivot, they stop the rate hiking cycle. So we'll see what we get in this one, but it doesn't sound like it's going to be any different.
So with the 50 basis point rate hike, we'll be sitting over 4%, around 4.25%. So if we do go to 5.1, let's just call it another 100 basis points. Rob, how do you think that? You think it's going to be? You think they're just going to get to that 5.1 right off the bat and stay, or do you think it's going to be drawn out? Maybe 0.25, wait a month, 0.25, wait a month.
No, honestly, it's all about what CPI does. I think, it's all cause and effect to what the number is coming in at. And, we're starting to see a larger dip in the CPI number. I mean, from 7.6 to 7.1, 0.5% just in 1 month. I think that we could see even closer to a full percent in the next print as well. So I think we're going to start seeing that come down drastically a lot faster. Let's get back to the Q&A. See what's going on.
Like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. Yes. And then I wonder what you're looking at as you determine when to stop.
As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy, and that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there.
Pretty safe to say. I think 0.75 is off the table now, right?
Yeah. Hold on, I don't hear what it is.
The strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply
we
conditions
kind of cover this. We cover this goods, core services minus housing, and then housing. We covered this in the beginning of the show. So what he's pretty much going to say, those are the three things that they're looking at. But my thing is, he just said we don't believe we're in a restrictive policy here. So why did they not raise it 75? They've been talking about getting to restrictive and keeping it there. He just said they're not.
Well, he was saying that he was slowing the pace down as well. So I think that was kind of my biggest takeaway from that answer to that question is that, hey, we're going from the speed we have to tighten right away, knee-jerk reaction, to a point where like, hey, we just need to get to our final target end goal, which is, he threw out the number 5.1. So I think we're probably in a likely scenario of 0.25 in the next few meetings, or at least that was kind of the gist or vibe that I got from his answer there. So.
All right, let's get back.
Lost by far, in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. 0.5 percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about 0.5 percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Pretty interesting. We haven't talked much about GDP when it comes to the federal interest rate hikes, and it seems like it's more something that's front and center here. Referenced it earlier, answering questions about it.
For the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But, what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And
slower pace,
that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of the...
And we got Bitcoin sitting at 17.8 right now.
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more, and so it didn't go up by much in the meeting, I don't think, but that's the idea is. Slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the
I think
costs
that's
in employment may be less.
just piping
Again,
in here on
that
this,
we're gonna
guys. What he's saying about the labor force is really important to understand from a psychological aspect. So what he's saying is that companies don't want to lay off, which is one of the reasons why we've seen the labor market stay so strong. The reason why psychologically companies don't want to lay off right now is because it was so hard to find workers for the last 2 years that they're scared that if they lay off these workers, then they're going to need workers in a year or in 6 months. And so right now they're saying, you know what? If we go into a recession, the Fed says it's going to be mild anyways, so I'll just pay these workers for the next 6 months, 8 months, and just deal with that expense. The bigger key is going to be if we get into a prolonged recession and then they start laying these people off. That's where things get really nasty.
Yeah, but here, Rocco, can we show this? What's on my computer here? But we showed this earlier in the show. This is job vacancies, and you can see that it's been trending up. If you just take away from 2021, just look at the last 3 months, it's been trending up. So there's more openings, job vacancies. You have the Great Resignation.
Is it also interesting in the narrative we had earlier where we were discussing that the interest rates hasn't played through the markets yet. And that it was only 6 months ago that we were at, below 1%. And so, will we see an uptick in job vacancies? I think so. I mean, it was only last month we had Meta lay off 11,000 people.
Here's the thing, though. If there's such a gap between job vacancies and people that are working or not working, then if those job vacancies go away, can't you argue that that'll just bring it down to even versus so off kilter, which is not what they're looking for, right? They're looking for unemployment to go up. But if there's 2 jobs for every 1 person out there, and those jobs go away because companies start laying off, then those people who got laid off will just go theoretically, we'll just go fill in those job vacancies that are available now. What are your thoughts on that, Magic?
I don't know if,
Can you repeat that real quick? Sorry, I was actually looking into some order flow.
No, you're good. So just talking about job vacancies and unemployment. If job vacancies are continuing to go up,
this is kind of anecdotal, but I've got a lot of like friends and family out here from the Midwest, and one of the biggest gripes that they have, and these are people that work from like everything from maintenance jobs to working in like corporate jobs, are telling me they're having a hard time getting people to stay and getting people to actually get hired on and fill out those positions. It's been a revolving door for them. People just don't want to go into the office. They don't want to go into the job, and they are having to raise wages. And it is kind of this battle to see who can get people. So do I think job vacancies are going to go up? I think, yeah. And I think if you're a viable candidate, it's a really good time to maybe go find a job. I'd just say, be careful where you land, because if it's a company that's struggling, when we get into difficult times, difficult decisions are made. So
I think
the biggest, not most rosy picture, but
the biggest thing to take away is that the labor force is shrinking with the massive retirement. So how many jobs are there for the populace here in the United States? And we've seen a slowing of immigration in the last couple of years as well. So how much does that play into everything? And then we're gonna get right back to the Q&A here. Just one second. Do either one of you guys want to show a chart on maybe some of the movements in the markets, how the markets are reacting to it?
We know. So because Gareth has to leave in a couple minutes here, Gareth, do you mind maybe showing a couple charts here before we let you go, my friend?
Yeah, absolutely. No problem. So this is the S&P 500. So again, this was the CPI gap up. So this is when the CPI number came out, which was yesterday at 8:30 in the morning. The markets, this candle's from 9:30 when the stock market opened, and we had this monster move up. And then we kind of went to sleep until obviously the Fed decision here. So you can see that so far it's a negative reaction, which again means that the markets were hoping for a slightly more dovish Jerome Powell. And we're not getting that. He's being pretty hard-nosed. He's saying, listen, rates are going to have to remain high. We may have to continue to hike, depending on what inflation shows us. It's not the hugest of sell-offs. It's not like we're down massively on the day, but certainly a negative reaction there. If we go to the daily chart, just a reminder, we talked about this downsloping trend line, and we talked about this just before that came out, how you had to respect that line, and we were right up into it going into this announcement. And you can see the daily chart on the S&P now selling off just a little bit. So anyways, that's kind of interesting. If we go to Bitcoin again pulling back as well. We now have, a pretty nasty reversal on the day. We've given up pretty much all the gains from the day on Bitcoin's daily chart, from 18,300 and change down to 17,779. It'll be interesting to see as this market digests these comments. Do we see continued selling in the next few days? Let's look at the dollar, actually. The dollar, if we go to the intraday, and there you go. So the dollar had a major spike on the comments. It's now coming back in, but the stock market's not necessarily rallying. Crypto's not really rallying back that much, considering the dollar pullback usually triggers a little bit of a rally in the equity or in the asset markets. So we're not really seeing that yet. We'll have to keep an eye on that. Otherwise, I'm trying to think of what other some good charts to show. We can look at gold real quick. We could see here on the daily chart on gold. Now, gold was into resistance, right? And by the way, I love this stuff because if we know that gold reacts inversely to the Fed, right? When the Fed is more hawkish, gold sells off. And we saw that gold was at resistance up here. It does give us kind of a slight bias that the markets may generally sell off and gold may sell off. Gold's only down a little bit, but nonetheless, it is pulling back just a little bit off that resistance today. So again, it's interesting. It definitely something that most investors didn't want to hear. They wanted to hear, free money for life. But I think reality is that at this point, the Fed is going to have to cap this. And remember, on a political basis too, even though the Fed's supposed to not be political, just on a society basis, inflation's really bad for the middle income and poor Americans, right? The rich can weather the storm. Doesn't matter if they got to pay an extra 25% on their food bill, they can handle it. Versus when you keep interest rates low, who gets rich? The wealthiest people, right? They're the people that can invest when asset prices go up. So I think the Fed is really inclined here to try to make sure that the poorer Americans and the middle income, they somehow can, afford to pay their bills.
That's 100% true, man. And it comes down to, you can say they don't really care about legacy or whatever, but no one wants to be known as the person who brought the economy or a recession onto the economy. So, Gareth, we know you need to go. Before we let you go, my friend, anything you want to, any partaking words or anything you want to leave us with? We do have, you want to follow Gareth and his trades in themoneystocks.com. The link to that is in the description of this video. Please go check it out. And anything else, Gareth, you want to leave us with?
Just continue to learn. I mean, I think keeping an open mind and just kind of being aware of how the markets factor things in ahead of time. Like the 50 basis point hike was factored in. It all became about what the comments were that we didn't know. That's what's driving the market now. And just be aware that, education is always number one. You learn about how to read charts. You learn about how to analyze the macro. And it really does benefit you in your life as a whole. So I encourage people to continue to learn, keep an open mind. You guys are awesome there at Sin City Crypto. I appreciate you guys doing this. I think it's a huge benefit, by the way, to have these live events where we dissect the real time what's going on, look at the market reaction. And Magic, always good to see you, buddy. So good to see you there, and look forward to our next meet.
Very well said, Gareth.
Thank you for your kind words, man.
We know you're an extremely busy, in-demand guy, and so we really appreciate you taking time and joining us. By the way, none of these guests have ever asked us for anything in return. All we ask of you to go support them. If you want to learn how to trade, you want to get into Gareth's program, please go click the link in the description of this video. Also, go follow our man Gareth on Twitter at Gareth Soloway. Gareth, thank you so much. We look forward to having you on again, my friend.
Thanks so much, guys. Have a great one.
Take care.
Thanks for joining us.
And then there were three, because we're the three best friends. Anyway, Magic, what's your? So you do a lot of day trading, right? What are you doing before a major press conference like this? What are you looking for, and what are you doing after? Moving forward, when we're done with the show and you're done. What are you going to be looking at? Is there a sector? Is there a chart? Is there indicators? Guide us through kind of your process, how we can maybe make money from everything going on right now.
Yeah, hang on just a second here. Let me pull up something on this computer. I'm just going to shut it down over here. Well,
I love your little Bitcoin piggy bank, by the way.
Man, I've bought a couple of those things and it doesn't work anymore, and they keep breaking. So I'm gonna stop buying them. They're only like $60, but I'm a sucker for it. My daughter loves it, so I just keep pulling the trigger.
Can't say no to the daughters. I have one too. Trust, it's hard.
Dude, oh, I know. Trust me. She calls me every morning at this point, even when she's not here. Tell me what she wants for Christmas.
Gotta love him.
It's all right though. So things that I'm looking for is looking for continual. This is the order flow. This is market orders. So most people don't realize that what moves markets are orders. I mean, at the end of the day, that's the driving factor, and news affects orders, obviously. So that's why I'm not a huge news guy. I love getting on the show with Gareth. I've met Gareth in person recently. It was great. And the reason is because he has so much experience that I can't get without actually experiencing these things in the market. So over time, you hope to strive to have that knowledge, but this is how I get by, right? So this is kind of a fairly new concept. It's been out since 2018. There are some people out there that'll do workshops on this type of theory, but Axia Trading is a really good one. There's some good books out there as well, but this is showing you market executed orders. So not limit orders. A lot of people like to use heat maps, but the reason I don't use heat maps is those are limit orders, and limit orders don't actually move the market. What limit orders do is once they're placed, they'll either absorb the market coming down or up, and then it takes new market orders to move the price. So what you're trying to do is catch the trend. So you had two tops here, and you can see that you've come up and you actually took the, well, I don't think you did take that high, did you? What is that? 375, and that's 367.50. So you didn't actually take the high and get the SFP, but you made it on declining delta. And when you come in here, what you're looking for are buy and sell imbalances. And so what this means is you can change this to be 200% or 300%, depending on how big of an imbalance you want. And what that is just more buyers than sellers or sellers than buyers. Obviously, these right here on the left, they're color-coded, so this is going to be sellers. It's going to be buyers. And so what you can see is as you're coming up into the peak, you actually have declining open interest, but you do have people opening up longs at the top, which is not the best move. And then you can see you have sell imbalances starting to come in and push the price down. 520K, 1.2 million, and you're putting these traders underwater. And this is a very clear sign with basically your open interest being flat, that positions are changing hands and someone's filling a short order. And so you need to follow the footprint, meaning that you're following the institutional trader. And we're not the market maker, as I alluded to earlier. I think I was kind of speaking on it just a little bit. You need to find out what they're doing, and then you're just riding that trend until that trend is gone, or that footprint is gone, so to speak. And what you'll notice is as you come into the bottom, what do? You get a big washout of 9.1 million in open interest, meaning that those people that were buying up here, they're now either being liquidated or they're being pushed out of their positions, right? And so this is usually an entry area where you start looking for entries. And I like to pay attention to time. I keep this a little bit more simplified than some of the other people out there. But I look for time, and these are all volume candlesticks. So these are not measured in time. These are measured in how fast volume is coming into the market. So I measure how quickly it's coming in, and then I see what the delta percentage is down here to see if it's positive or negative. And what you can see here is you have a bunch of negative delta coming in at the lows. You have people getting pushed out of positions. And then you see a shift right here in positive delta, showing you that new market longs are coming in, and you get a back test of the VWAP. Right? So as a day trader, this is a great trade for me. I'm getting in right here on these new buy-in balances that you kind of can see. And then I'm putting my stop loss below the low. And it's not a huge move, 17,820 all the way up here to the high at like 18,000. So it's $180, 1%. But that's a really great day trade, to be honest with you. 1% is a big move for a day trade. So that's what I'm doing. And I wash, rinse, and repeat throughout the market. Now, I do use charts as well to notify me where I'm interested in that. So I do live on TradingView, and there's a lot that you can do with technicals. And I believe that I'm one of the more technical people in the space. And I strive to get the experience to, also have the fundamental knowledge and things like that over time. But again, it's a timing thing. Like, you can't just learn this stuff overnight. It's something you have to experience for yourself. So I do rely heavily on technicals and a little bit on the order flow. The order flow kind of helps me out. But once we get into these positions, I set my alerts, and I go from there. So I was already expecting this level. A really fun tool that I'm known for is pitchforks. I fork a lot of different ways, but this was one that I had. Pitchforks. Yeah. So these are time and trend tools, basically. So I had pulled this one up earlier, and this was an idea I had yesterday. I was looking for something a little more dubious, something like this. So this would imply that we actually continue up into Friday, but it's not something I'm married to. That was, again, that's why it's labeled dubious in my folder. But this fork, however, is a time and price tool, and you can see it catches our exact high, basically. The EQ is fairly well respected, and so it's just something to give you an idea of when the trend is overextended, right? That's all you're looking to do is, okay, when is the trend overextended? When should I be looking for a reversal? And then I go into the order flow and see if there's anything beneficial for me to take advantage of it, right? And that's what I do. That and harmonics. Like, I like to tinker with both of those quite a bit. But, that's, in a nutshell, that's it. And to this one right here on the daily, the only thing that really matters as of today, right now, is going to be recovering the previous day high at 18,011. And it's likely going to be very similar to your daily. No, it's not your daily point of control. What is the daily point of control on XO? Because that's a 40 tick. This is a 1 tick. No, yeah, the true daily point of control is 18,100. That's another really big advantage of like this type of software, is you can get a little bit better levels and volume levels. So 18,100, that 18,000 to 18,100 level, you really need to see that reclaimed if you're going to get any kind of continuation out of this move. And that is going to be your previous day high, So when you come to your previous day high here, if you start closing back above that, you've now flipped it into support. You would make the assumption that you're going to at least attempt to fill out this wick a little bit and maybe even come up and formally backtest the standard deviation range, which this is where the 70% of volume cuts off. Nothing's meant to be perfect, but it's always important to kind of understand how the market moves, I guess, and go from there. That's it.
Amazing.
Hopefully that made sense. I go into like these full rants, so you guys got to cut me off sometimes.
No, you're good, man. Look, this is important stuff. Your order was it order flow or?
Yeah, I order flow.
Yeah, that one
I can send you guys a book if you want a book on it. I'll send you one.
Yes, please. Man. I've never seen anyone use that. I've never seen anyone use that. It's very intriguing, especially if you're a technical or a numbers person. Which, by the way, if you want more Magic Internet Money, please go subscribe to his YouTube channel, Leading Crypto. The link is in the description of this video. Magic, I want to ask you just kind of in a general sense, and I'll ask Rob the same thing. With what we heard from Fed, from Jerome Powell, slowing down rates, still want to get to 5.1. They're going to keep it there for a while. What do you see? What's your outlook on 2023? And you don't necessarily have to show a chart if you don't want to, but just your feel. What are we going to see 80% sideways with moves up and down, here and there? Are we going to see maybe a 3-month sustained rally either way? What are your thoughts just with what we can expect moving forward in 2023 with Jerome Powell and the Fed, and how that's going to translate and correlate into specifically cryptocurrency and Bitcoin?
I'll take that. I think that moving forward, we're gonna be in an environment where we're coming out of the depths of the bear market. Everyone wants to call bottoms and say it was here or there. I think we can all agree that at least through the second half of 2023, we'll be out of the bottom of the market. I feel comfortable saying that. Now, is it possible that we go to a recession, we go to even further lows late next year? Anything's on the table. You never know. The black swan events can always hit. You can have another
a white swan event too,
or a white swan event. Yes, but I think it's safe to say that we'll be out of the bear market sometime next year, or we'll be at least out of the bottom. And so right now, it's about where are you going to position yourself? No better time for a great entry point into securing a long-term position than now. Honestly, even if the bottom was in, we're only $1,000 at least off of Bitcoin from the bottom. And if it does go a little further down, it probably won't go too much further down than the 16K. And even if it does go further down, 10K or whatever, I know there's all kinds of large numbers getting thrown out there, but even if that was the case, we do understand that the bounce back will far exceed 17,000. So if you have a long-term time horizon, what a better time than now? I
want to point out something positive here. Okay, take FTX out of it. Right, we were sitting at $20,000. With the most aggressive monetary policy from the Fed in decades, okay? No quantitative easing, no money flowing in, and Bitcoin was at $20,000. I want you guys to take that as a sign of positive, that when they do pivot, when they do pause, I think we're going to see a nice
And the
rally.
fact that you had the third largest exchange in the world, FTX, go under, and the price movement of Bitcoin went from 20K just to 16K. I think that in alone is pretty telling. I mean, I would expect
that's still 20%.
20%, but I would think that number 3 exchange that would, if you were to ask me before that happened, I'd be like, oh man, if Coinbase, Binance, or FTX were to go under, hey, I could see Bitcoin at 10,000, 8,000, 6,000. I mean, who knows? I mean, that is such a catastrophic event. And the fact that it's only a 20% swing, which in our world and the crypto environment, 20% is not that crazy. So I look at that as a positive.
What are your thoughts, Magic, on the question I originally asked you until Robin intercepted it? No, in all seriousness.
Could you rephrase it real quick? I want to make sure I answer it the way you
No, you're good, man. You're good. So I just said, we now know coming into the end of the year, going into 2023, 5.1 is their target. They're going to stay restrictive. They don't think they're restrictive yet, but they also believe in slowing down the rate hikes. Knowing what we should expect in 2023 from the Fed and from macro, what do you see happening in crypto and Bitcoin as far as price action? Is it going to be 80% of the year sideways until we get closer to the halving? Is it going to be sustained rallies for a month, 2 months, 3 months? What are your overall thoughts on where you see projection of what the markets will do with the new Fed projection?
It's a great question. I think that at this point you almost default to traditional markets a little bit, even though I'm a crypto guy. Like, I'm diversified, don't get me wrong, not as diversified as I should be. I'm a pretty big Bitcoin maxi, but I think that sideways and down is still maximum pain, and I don't know that we've actually seen it yet. I know it's not a popular opinion, but it's just kind of what I'm seeing. So like I said, I've been holding a short for the better part of a year. I'm coming up on a year in 2023, and I've had no urge to close it because there's been no reason to. I think that with the federal funds rate being where it is, and in past circumstances, when you pivot or they stop raising rates, the markets actually haven't bottomed yet. They usually sell off after that effect. And the reason that happens is because they, their job is to control inflation and the jobs market, essentially. Those two have to be in unison. The issue with a straw job market is it gives them the leeway to continue restricting rates until something breaks, essentially. So when they say that, it takes time. And I think Gareth had made a comment a while back, and he's like, good news is bad news and bad news is good news until bad news is bad news. And that's a reflection of the job market. So once that is gone, there's nothing really to prop it up at that point. People aren't spending that money, things like that. So in my personal opinion, I don't think we've seen the bottom just because of that alone. I don't know that we've seen it. If Bitcoin has the chance to do a spectacular rally coming into 2023. I won't lie. I've already covered it a little. I touched on it with you guys weeks ago, and I've kind of covered it in the group so that they're well prepared, because I don't want them to get their faces ripped off by it. But there is the potential to see something like, I'm serious. So I'm a big time and price. I'm also a big average guy in terms of mean reversion. So back when we were dipping down to 32K, I was looking for 47,707 based on an average that we knew was coming in to start the new year. And we have a new one coming in, and it's going to be coming in around 27, 28K, depending on where Bitcoin closes out this year. Okay. So we know those hit at about 80% hit rate. It's a pretty good size rate. So if we start seeing the flip of something like, and it's not popular to say, but 21.5, I think you could early call it at 20,688 to 20,904, splitting hairs over a few dollars. But if you saw something like that to me becomes an immediate target. And that's a huge jump in target, I know, because a lot of people are going to be like, well, why would you skip over 23K and 24K? The main reason being is if you looked at the chart, I don't even need to pull it up to tell you this, how much time have we spent above those local highs? All we did was put in lower high, lower high, lower high, right? Where are people's stop losses at? Right. Usually right above the local high. So it accelerates things very quickly, and it begins to really hit those, and that's where you get a true short squeeze. And that's what you saw when in 2019, and we dumped down to $7,200. Everyone was looking for $6,000. And we covered this a little bit on your show, so I was talking about what we alluded to. You start holding 17.5 and getting back inside that range and then recover some of those, you're just going to fill an inefficiency and do a mean reversion play at that point. Doesn't mean the bottom is necessarily in, but what it does mean is if you're on the right side of it, you can make a lot of money. Does it have to pan out that way? No, because the downside to an average play like that is that when you don't hit a meaningful average like that, the 20% of the time you don't hit it, you trend so hard in the opposite direction because the trend is so strong, you never actually see that average. You trend really hard. I used to do this on the daily time frame even for those, and I had like statistics built up that if we didn't hit the daily average, which it was hitting at 88%, 94 some months, you trended like 3%. Yeah, you trended like 3% the opposite direction. So it's just sticking to what I know there. I just trade the ranges. But for me, if Bitcoin recovers like 20,688 to 21.5, I'll probably close my short from, just a hair over 40K and look for an entry again or, revisit. But for me, it's a hedge because I do hold a lot of Bitcoin and I didn't want to hold the drawdown. So what I did was I took 15% of my overall capital. This is what leverage is for, folks, by the way, for anyone that doesn't trade. Leverage is not meant to make you rich overnight. What leverage is meant to do is allow you to upload less money to exchanges and still get that exposure if you want it. So I uploaded 15% of that capital and I leveraged it at 11x, which is pretty high for that amount of money for me. And that gave me a 6% of my total capital in profit, protecting against the drawdown of the rest of it with the initial 9%. So that trades up a little over 15x right now. So I've effectively doubled my entire portfolio hedging against the market and not touching it for a year. It was a really tough trade to not tamper with when we got down to like 17.5 the first time and went all the way back to 25. That was a tough one because you had the hash ribbons buy signal, you had all these things. And so I think that it's tough. It comes with experience. And I think that in crypto, I'm one of the people look to and say, oh, this guy has a lot of experience. But in reality, I don't in the world of trading. And we're all learning. And this has been my most successful long-term trade because I am more of a day trader. But if you're looking for a bottom, I think you guys are going to have to be patient. I think you're going to have time, as you alluded to earlier. We're only $1,000 off the bottom anyway right now. Right. So if you're patient enough, you know, you might not get to buy the bottom. I didn't sell the exact top, but I still made out very, very well. You know, once I was like, okay, this range is likely going to break down up here, I should be hedged short, and I do also want to make some money on this, but I don't want to be overexposed, because that's how you get emotional and you close too early. So like, say I closed it at 25K, for instance. Well, if you close at 25K and it dumps all the way down to, let's say it does dump down to, oops, sorry, my alarm there, does dump down to 10K, then, you know, you've effectively given all those gains back, right? So
you know,
just
what
depends on your strategy.
I love how confident you are in saying I don't have a ton of experience trading, and I think that just goes to show people, if you truly enjoy doing something, you don't need 20, 30, 40 years of experience. Obviously, listening to Magic for the last, having him on the show before and having him now, you can. I'll be happy to put him up against a veteran trader of 10, 15 years, and I bet you he would know more stuff. So, Magic, great content as always, my friend. Anything you want to leave with? You know, obviously leading crypto, you have a partner, CVO Crypto. You guys do TA and stuff on your channel. We have that linked in the description of this video. Please make sure to go subscribe. Also, go follow Magic Internet Money on Twitter. Rocco, if you want to pull this up, we'll show it here. At Magic Internet M1, not M2, but M1. Follow him there. Where else can they go to find you, or anything else you kind of want to leave us with?
I do have a personal YouTube channel as well. It's just Magic Internet Money. Hard to miss. But yeah, Leading Crypto, that channel is the one we're going to be most active on during the day. So we actually go live every single morning when the New York Stock Exchange opens, when futures open. Cool. And if there are trades available, we give them out real time. We actually take the trades too if they're there and available. And we just walk through everything from the daily setup. So if you're like, how do you set up your daily charts? What do you do to prepare? Well, this will give you a good insight of how we look for levels and what we're looking for. And it's free to the public, you know. It's kind of like you were saying, where I've got over 10,000 hours on the charts easily at this point. Like, I've been fortunate enough to not have to work for the last, you know, almost 4 years. And this is all I do. But there's no shame in giving people free content, because if it was as easy as you watching me for an hour every day in becoming a profitable day trader, everyone would do it. This is a pretty tough, the smartest people in the world are competing against you for the same prize here. You have to think of it that way, and not just them, like whole companies. So if you guys want free content and you guys want, you know, good trading content, that's really what it is. It's for traders. I'll be upfront with you. We're not like a big fundamentals. We don't cover the news. I come here to watch you guys for that. And yeah, so it is one of those things where if you guys are into trading, you know, give it a listen. It's a little different. The tools are different. Let me put it that way. You're not going to see these tools too many other places, but they'll make their headway through.
Yeah, guys, please go support Magic Internet Money. Go follow him on Twitter. Subscribe to YouTube. You bring the fire content as always, my friend. Thank you so much. We definitely know we're probably going to bring you on again in the future here, if you would accept our invitation again.
No, absolutely. I'm trying to get I'm trying to get my order flow guy here to you guys. If you guys want like real order flow, like, so we have a guy that's all he does, and he actually is in charge of that portion of our academy. Cool, man. And he was in your chat. He was giving out the name of the book that I was telling you earlier, because I didn't have it off the top of my head. Yeah, Burmax. And he's over in Dubai. He's a guy I've been, you know, helping learn to trade for the last few years, and that's all he does over in Dubai now. He's got a little apartment over there with a great view. I'll be seeing him probably this next year. We'll go hang out. I'm going to cash out some Bitcoin over there. Wonderful. And
I'm trying to get him over here. We're just pulling up.
There you go.
We're pulling up his YouTube comment. There it is. Mark your profile, order flow, next generation of day trading. Bam. Well, guys, you know, as you know, being part of our community, you're always going to get guests of this caliber that bring you different perspectives, viewpoints. We think it's extremely important as a community for you guys to be able to get multiple different viewpoints and get other people's opinions. So, Magic, thank you again, my friend. Enjoy the rest of your day, and we'll see you next time.
We'll see you. Thanks, guys.
Thank you. Also want to give a big shout out to Jimmy, who dropped another 10 super chat or 10 memberships.
The hype man.
That brings his daily total to 30.
Wow, we should do a chart on Jimmy.
Yeah, you know what? Like, you could probably track the price of Bitcoin and its movement by his gifted memberships. You know, the volume there.
There is a lot of indecision in the markets right now. You know, Dow's printing a spinning top on the daily. Bitcoin, not necessarily spinning top, but on the 5-minute, we are seeing a bear flag on the 5-minute on Bitcoin. Is it on my laptop?
Yes, it is.
There we go. So again, this is on the 5-minute, move to the downside, uptrending parallel channel. This typically does break to the downside, but did we get enough clarity from Mr. Powell, Robin? Did we get enough clarity from the Jerome?
I think, the markets or the markets are the ones that say it best. I mean, take a look here. You have
markets are essentially now
they're flat. They're flat, and they're down. Nasdaq's down 0.4%. So I think this is the least amount of volatility we've seen in the last few months when it comes to these meetings. And so for that reason, I think that you can just say it. Hey, came in as expected. Nothing.
Came in like a wrecking ball.
It did not come in like a wrecking ball. It came in as expected. And there was no surprises here. Powell came in saying his normal frequent sentences. We're going to stay the course, target range, long term, all this. I think today was what we expected. At least what the traders were expecting,
guys.
And so for that reason, we didn't see big movement. I do want to give a little shout out though, real quick. We had a few new people in the chat, I could not get to all of you. So if we missed your name, sorry. Say hello again. Come join us again in the future. We got Bruce W, Ryan C, Overcome, Scaroot, Dean Danner, JT. We got Fernando, Julio, Sailing to Crypto. Let's grow in the moment. YC 1903, Joey Soloway, who claims to be Gareth's son. Oh, by the way, and then we got Nitro son. Burp, and as we mentioned, Burmox as well.
Burmax.
Hola!
You cannot speak.
Welcome,
guys,
to Sin City Crypto, also known as Creepy Show. Creepy Dough.
I want to kind of talk with our community here. To those of you still here, first of all, to those of you that have been with us for a while, thank you guys so much. We love you guys. We love the support. To all the new people, this is the dopest community out there. I'm telling you guys. I know everyone says it. We have the most giving, funny, interactive, helpful community that I've come across in the entire space. And let's just take a look at 2022, okay? We had some of the biggest black swan events. We have the largest fraud to occur in the history of the United States in FTX. We had the Celsius meltdown. We had Terra Luna collapse. We had stable coins get depegged. We've had Bitcoin dropping under 15.5, under 15K. And we are still here. 2022 was a rough year. I'm telling you guys. 2023 might start off a little rough, but I got a good feeling that going into 2023, we're gonna see 30K Bitcoin. I don't know if it's gonna stay there, but we are gonna see a 30K Bitcoin. Then going right into the halving, things are looking up. I know emotionally, mentally, there's been days and sometimes weeks where I've been mentally beat down, and I'm sure you guys have done the same. But you've made it this far. There's no point in turning back now. Stick through. Also, on that note, Rocco?
What?
There's a few things we do very good here. And
oh, you're terrible at that.
Your mouth. Says the guy. No.
There's a few things we do good here.
There's a few things we do good.
I know how to read good. I know how to read good.
We do a lot of good things here in Vegas. 1, nightclubs. 2, we have the best pools. 3, we have the best cryptocurrency show on the internet. And we also do clubs. When we hit big milestones, we celebrate with our community. You literally took what I was going to do, you clown. We love to celebrate with our community. We did hit our threshold of 500 viewers. So what do? Rocco?
We open the club, baby.
Open up the club, baby. Oh, man. Guys, go check out our Twitter. Follow us on social media. Go support our guest, Gareth Soloway, on Twitter. Also, inthemoneystocks.com. Magic Internet Money. Go follow him on Twitter. Also, join his, go subscribe to his YouTube channel. Also, if you're not subscribed to us, why? Subscribe to us as well. You're getting double David. On behalf of myself, Robin, Rocco.
I want to say one last thing.
Hurry up, man.
Big shout out to my boy Rocco over here, killing it. We put this guy through the ringer to get this production done.
He did an okay job.
The magician behind the scenes, the Oz.
I'm going to talk you later.
You did okay. On behalf of myself, Robin, Rocco, Kyler, and Gareth Soloway, and Magic Internet Money, thank you guys so much. We will see you tomorrow, 10:30 a.m. Pacific Standard Time. Until then, guys, peace.